Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today.
Yes, the Department of Justice is weighing a historic breakup of Google. The DOJ writing in a filing it's considering, quote, behavioral and structural remedies that would ultimately help prevent monopolistic practices by Google. This comes after a judge back in August ruled that the tech giant holds a monopoly in the search market. A judge will have to weigh in on the proposed remedies. Google likely to appeal whatever decision is made.
Talks between Boeing and the machinists union have broken down. Boeing saying in a statement future negotiations do not make sense, and it has withdrawn a contract offer after, quote, the union made non-negotiable demands far in excess of what can be accepted if we are to remain competitive. The union saying that negotiators, quote, attempted to address multiple priorities that could have led to an offer we could bring to a vote, but the company wasn't willing to move in our direction. The union, representing more than 30,000 workers, has been on strike for nearly a month.
And Wall Street is awaiting more Fed speak today. We'll hear from Fed Presidents Bostic, Logan, and Goolsbee, among others. And the minutes from the last FOMC meeting where the Fed cut rates by 50 basis points. That's going to be out at 2 p.m. Eastern Time. All of this will give investors more insight into the Fed's thinking around the pathway of rate cuts. Our top story, a potential breakup of Google's empire. The Department of Justice is weighing potential sanctions against Google that could force a breakup and dismantle the tech giant's dominance of the online search market. This comes months after a federal judge ruled that the company violated antitrust law with its search engine labeling Google as a monopolist. Yahoo Finance legal reporter Alexis Keenan has more on this story. Hey, Alexis.
Hi, guys. Yes. So what we got yesterday, very late into the evening, is a framework proposed by the DOJ. And what it is it's telling the judge how they're going to proceed through the next phase of this trial, which is the remedies phase, to help the judge through their arguments. The DOJ says that it wants to do a number of things, but what's really consistent throughout this document is the idea that they want to make sure that Google does not have future harm for alleged monopolistic behavior, in addition to what's already happened in the past. Now, let's go through the things that the DOJ is telling the judge they're going to be looking into over the next months here. First, they would like to limit or end the contracts that place Google in a default position on internet-connected devices, including browsers, apps, and as well as AI search tools. So you can see there they're thinking about the future and how the development of AI in search is going to impact and possibly further entrench Google into this ecosystem. Now, next, what they want to do is to give rivals access to Google's data. Google, I think, would argue that that's their intellectual property, their special algorithms that make their search engine good. But what they say is they want to give access to rivals for indexes, data, feeds, models, and AI-assisted search tools, especially on mobile. Next, they want to let websites that Google crawls for information, they want to let them opt out. And what would that do? That would stop Google from continuing to bolster its index, and it would give it less opportunity and give rivals a chance to get in there. They say that would stop Google's advantage over web content. Finally, there's that part that is not the general search market, and it's the market for search text advertising that the DOJ is talking about. They want to help rivals scale here, they say, by potentially licensing Google's advertising feed. So a lot of different proposals there. They also include going after Chrome, Google's browser, the Play Store, Android, all of these things on the table for possibly being excised from Google and having it divest those companies. Let me just read Google's response here. They posted a blog saying that the proposals are radical and sweeping. They said they risk hurting consumers, businesses, and developers. They say, we believe that today's blueprint goes well beyond the legal scope of the court's decision.
Alexis, there's a lot to unpack there, but I also want to, because you took this angle in the story that we have up on Yahoo Finance right now, and was titled that this really puts the tech world on notice. What do you think some of these other tech giants or maybe analysts or investors out there who are watching right now should be thinking about maybe how this lays the groundwork for some of that future pressure that we could see from for or against some of these other big tech companies?
Yeah, Google just had another trial wrap for advertising technology, an antitrust case in Virginia. Then you have Apple facing DOJ charges. That trial has not ramped up yet. It's going to take some time. You have Amazon facing the FTC. You have this big lens on big tech right now. But I think certainly this proposal is a step in the direction to try to finally see what's on the DOJ's mind, right? A breakup isn't something that has to be proposed as a remedy. That's just something that could be put on the table, and the DOJ absolutely putting it on the table here. So I think it is an indicator of the Justice Department, maybe under any administration, because this case was brought under the Trump's DOJ, of what they would like to do. Cast a big net, I guess, is the message here. But there will be more to come on November 20th. That's when the DOJ will make a much more detailed proposal. This one is kind of broad brush.
You mentioned the blog post that Google had published in response to this. How much defense do they have here, especially with the allegations of the monopolistic tendencies that have come forward?
Yeah, they're absolutely going to get an opportunity to put on a rigorous defense. This is a whole nother part of the trial. They are going to be able to make arguments that even the DOJ should be able to access certain information that's proprietary to Google, or they shouldn't. It's going to be a whole nother round of them being able to dig in their heels and say, this is our intellectual property. We either need to be compensated if it's going to be shared with rivals, or we need to block access to it, and we can expect them to fight hard in order to keep that under their own umbrella.
All right, Alexis Keenan, thanks so much for breaking this down for us. And next hour, we will be speaking with Mozelle Thompson. He's a former FTC commissioner, about the implications of this. All right, Alexis, thank you. FOMC minutes out later today, and it will give investors insight into the Fed's view on inflation and the economy. The release coming ahead of tomorrow's CPI data. Joining us now, we want to bring in Kenny Polcari of Slatestone. And Kenny, it's great to have you here. And let's talk about the implications of the FOMC minutes. Lots of focus on how this is going to, or really giving us some insight into how the Fed is thinking about the economy at this point. Yes, how confident are you in a soft landing, given what we've heard in some of that rhetoric coming out from the Fed?
So, I'm in the camp that I'm not sure it's going to be a completely soft landing. I think we actually want a little bit of a harder one in order to help bring prices down. But I think what the market is assuming, or what the market is really hoping for, is that we're going to have that they've succeeded in creating this soft landing, and that it's going to be all good. I actually am in this camp that I think that they need to keep rates where they are. I don't think they need to cut rates next month. I actually think the market's trying to tell you that maybe they're not going to cut rates next month. The labor market is not falling apart. The economic data is not necessarily collapsing around us. And there is a risk that inflation is going to start to rear its ugly head again if oil continues to rally.
Kenny, as we think about so many of the risks to the outlook here for investors, it seems like for the shrugging off that the markets have tried to do, they've done a pretty good job at that to this juncture here. So what type of momentum do you see kind of in the rally after some of these larger events that are immediately on onset looked at as potential and major headwinds, but that the market just continues to shrug off over time?
So I think it's actually amazing that the market has shrugged off a lot of what's happened, right? Not only from the geopolitical side and the conflicts going on around the world, but even what's happening here in the United States, from the presidential election and the opposite sides that the candidates are on, and what that means for the economy, as well as where we are with the Fed, right, and with inflation and with interest rates. So here's what I think is going to happen: if we continue to see bond yields rise. Now, look, they went from 360 2 weeks ago on the 17th of September when the announcement came out, up to 405 yesterday. 407 is a trend line resistance in the 10-year bond yield. If we pierce up and through that, then 416 is the next level. That's the long-term trend line resistance. That's certainly going to cause some headwinds for stock investors, equity investors, if they fear that yields are going to continue to move higher. And I actually think they're probably going to move a little bit higher. I don't think they're going to spin out of control, but I do think that's going to be the catalyst that's going to continue, that's going to try to control, at least put a top on how stocks are advancing and let it pull back a little bit and churn. But don't forget, we're 3 weeks away from the presidential election cycle. The Fed is not going to let the market collapse 3 weeks ahead of that cycle. They're just not. They're going to do anything they can to kind of hold it in place. It's after the election, after we know what the result is, that then I fear that the Fed's going to allow the markets to trade more freely and allow them to pull back. And I think that's what investors need to be cautious for.
And so we have the FOMC minutes that are going to be out today, and that's the last meeting, but we've got a lot of Fed speak ahead of the next FOMC meeting as well. What do you expect in the tenor for what you're saying? And the Fed won't allow the markets to collapse.
Right. So I don't think you're going to hear much from the minutes themselves. I think Powell made it very clear kind of what the tone of the meeting was and where everybody stood. Although yesterday we had Fed President Susan Collins come out talking about the Fed needs to be methodical and they need to act slowly, which to me says that she thinks that they need to pull back a little bit. They don't need to have another jumbo 50 basis point rate cut. I'm not even sure she suggested it needs a 25 basis point rate cut at the moment. I think gold is telling you that. There are a bunch. We're going to get Tommy Barker. We're going to get John Williams. We're going to get Austin Goolsbee. We're going to get Raphael Bostic. All Fed heads that are going to come out over the next 2 and 3 days giving their opinion. So I think you have to take some of that with a grain of salt because, trust me, there'll be, someone's going to say one thing, someone else is going to contradict it with another. So Austin Goolsbee would love to see rates go lower much quicker. Yet, like I said, Susie Collins says, not so fast, big boy. I think you need to slow down there. So I think it's going to be confusing, and that's going to continue to cause confusion for the markets. Nothing I don't think that the markets can't handle. I think I think it'll be frustrating for investors.
And it has been frustrating for investors, and we've seen that play out in the market. Kenny, last time you were on with us, you were sitting in studio, you were talking about opportunities within consumer staples. Here we are about a month later. Is that still a play that you like at this juncture, given some of that uncertainty that you're talking about? And what do you like within consumer staples?
So 100%, because I think, you have to, not that you're going to get rid of your growth names, right? I own plenty of tech names. I'm not getting rid of those. I'm just putting new money into more defensive sectors, and consumer staples are an area that, demands attention at the moment because people need consumer staple stuff, whether or not the economy is strong or weak. You're still going to go out and buy the stuff you need to live. So names like Costco, names like Walmart, I think are core holdings in a portfolio. Costco's actually pulled back. It is up, they're both up nicely. I think Walmart's up about 15%. Costco's up, I think, about 40% on the year. But Costco's actually pulled back from its recent high, and I think presents an opportunity. I'm waiting for Walmart to pull back a little bit more, and then we would add to it. They're both names that we own. Both names that are part of our core portfolio. So it's not like we're trading them, but we would look to add to them on weakness, right? And I think in order to build up a defensive position, and I think people, whether they're doing it on their own or they're doing it with their manager, need to consider having more exposure to defensive. So it could be utilities as well. Look how well utilities have done this year, up 25%. For the most boring sector in the S&P, it's the best performing sector just because people thought rates are coming lower. They're high dividend payers. They're considered defensive. But Walmart and Costco in that consumer staple division.
Kenny, just lastly, while we have you here, we had on Dana Peterson from the Conference Board yesterday, giving her assessment of the consumer as of right now. And within that conversation, it was really evident how much the pressure that the consumer has faced is going to show up within this Q3 earnings season, and even more so in the guidance that we get from companies. How do you think that could play out, and what does that mean for earnings growth that companies are going to be forecasting, and how that kind of pertains to your overall assessment and projection that you were just breaking down?
So I agree with that because I do think that you're going to start to see a little bit more muted guidance. I'm not so worried about what the earnings are today because the earnings are basically history, right? They've already happened. It's done. It's really what they say going forward and how they're going to present the next 4 to 6 months. And I am a little bit concerned that you're going to start to hear more cautiousness. I don't think you're going to hear disaster, but I think you're going to hear more cautiousness coming from CEOs as they try to rein in expectations for next year because they are concerned. They're concerned about where the economy is going. They're concerned about what happens after the presidential election, depending on who gets in. That's going to dictate policy. And then that's ultimately going to dictate how consumers react, right? So I think you have to listen carefully to how they're positioning themselves. But I agree. I think I'm playing it more on the safe side by actually expecting less. And if they deliver more, I'm great. But if I expect less and I prepare myself for less, then I'm not going to be disappointed.
All right, Kenny Polcari, who is the Slate Stone Wealth Chief Market Strategist. Thank you so much for taking the time here this morning ahead of the opening bell. Appreciate it, Kenny.
Bye.
Thanks. Coming up, everyone on Morning Brief. Boeing withdraws its offer to 33,000 striking factory workers with no signs of resolution ahead. We'll bring you the details. Plus, we count you down to the opening bell on Wall Street as tech takes a hit amid the DOJ's Google proposal. And we'll bring you real-time coverage of Hurricane Milton as the Category 5 storm sets to make landfall in Florida today. All of that and much more on Morning Brief.
Now it's time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Taiwan Semiconductor reporting better than expected third quarter revenue driven by the continued AI boom. The company will report full third quarter earnings next week, but again, taking a look at the stock reaction, you can see some excitement here of just about 0.8%. You can really see the excitement playing on some of these chip stocks. We know Taiwan Semiconductor here, a main chip maker to Nvidia, to Apple. So some of the fact that we are seeing strong demand here for Taiwan Semiconductor chips, obviously a positive sign here for some of these companies and maybe what demand looks like on their end. But again, this is just follows a string of very, very strong results, very, very high demand for Taiwan Semiconductors. And you can see that clearly in the outperformance here of the stock over the last 6 months, over the last 12 months, clearly an outperformer as they have been able to regain some of that momentum.
Yeah, I was doing a little desk arithmetic before the show here and ultimately looking at the September month specifically isolated within this report from Taiwan Semiconductor. Reminder, of course, we're going to get the full third quarter earnings on October 17th. They're also going to give us more update on the outlook there. But all these things considered, that September number that I was mentioning and doing a little bit math on the conversion there from the new Taiwan dollars into US dollars, about $7.82 billion USD. Why is that important? Well, that continues to solidify what's expected this third quarter based on the previous updates that we've gotten here. We were looking for this range. Previously in July, we had heard an update from Taiwan Semiconductor. They forecast this range of $22.4 billion to $23.2 billion from the quarter, and it very likely could come in just above that. And so that, no doubt, is being priced into the stock here today, even though it's just a fractional move higher by about 0.8% right now. Arithmetic, love it. Also, those
You're all over it. You always are, every month.
Look, I mean, I'm just saying, we got to put some
In
of
case
these...
there's any confusion out there.
These K through 12, tools got to be put to use at some point here. Also, those strong TSMC sales could give Nvidia a boost. Shares nearing a record high after Foxconn touted strong demand for artificial intelligence servers, according to Piper Sandler's teen survey as well. Get this, Nvidia's video games graphics cards, they maintain the lead share of the market at 45% compared to AMD's 14%. There you're seeing shares up by about 1.3% right now. I mean, why wouldn't it be among the top of the teen survey right now? It's essentially the Roman Empire for all of the teens that are out there that need graphics cards. So when it's in the lexicon like that, of course, it's going to have some type of outsized mind share at this juncture.
Yeah, you know what's so interesting? We talk about the fact that obviously NVIDIA not necessarily as reliant on their gaming revenue and maybe what that demand does look like relative to what we have been talking about with the stories surrounding NVIDIA 5, 6, 7 years ago. But still, I think this just speaks to the demand, the stickiness of their product, how they are the leader within the space. When you dig into this Piper Sandler survey, I was actually a bit surprised to come across NVIDIA. I mean, many times when we talk about Piper Sandler survey, we're talking about many of these consumer-facing brands. When you think of Nike, Lululemon, Elf Beauty, the list goes on. So the fact that they were asked about some of these chip stocks and NVIDIA was among the names that had been talked about just in terms of the demand here for GPUs, it took me a little bit by surprise, I gotta be honest.
These teens are smart. Teens these days are more connected than we were even when we were growing up.
That is for sure.
Which is insane.
I think I didn't even get my first cell phone until 10th grade.
Well, it's like lighter fluid that they've had in terms of the technological innovation that they've been able to tap onto. They're probably getting cell phones, much better cell phones than we had at a younger age. But all these things considered, there was also a conversation that I did just want to bring up that Jensen Huang actually had with ARMS, even though, of course, we know Lisa Su, Jensen Huang, hey, family, it's fam. But at the end of the day, he did have a podcast or conversation that he was on with the ARM CEO, the podcast hosted called Tech Unheard, essentially. And they actually mentioned within that podcast, Jensen Huang did, saying that he wants to drive down the cost so that they can deliver this new type of reasoning inference with the same cost and responsiveness as the past here. And so just think about the supercharged tenor that generative AI as a trade thesis has had thus far. And now think about the fact that Jensen Huang is trying to make these chips even faster, even more responsive for the inference technology that they would really like to bring to fruition here.
Yeah, focusing very much on cost, saying we all realize the value of this. If we can drive down the cost tremendously, we could do things at inference time like reasoning. So again, just talking about the trajectory and the opportunity that lies ahead within AI.
Next up here, let's talk a little Boeing. Shares, they're sliding as negotiations between the plane maker and its striking workers breaking down this week. S&P placing the aerospace giant's credit rating on credit watch negative as the strike continues. To discuss this, we're joined by Tony Bancroft, Gabelli Funds Portfolio Manager of Aerospace and Defense ETF. Great to have you here with us. So first and foremost here, you hear about these talks breaking down. How far could this continue to go on at this juncture, as it seems the two parties are not even close to potentially netting out a full deal that will be brought to a vote?
Yeah, thanks, Brad. Great to be back. Who knows exactly how long this is going to take? I don't think it's going to be much more of a meaningful amount of time. Obviously, historically, the last strike lasted almost 2 months. Obviously, that wouldn't be great for Boeing, but last week, the employees received, missed their first paycheck, and obviously we're off of healthcare. So, we'll see where this goes, and I think the big picture is sort of a near-term blip, and in the long term, there's a decade plus of backlog for commercial aircraft demand for the two OEMs, and Boeing is one of the two. And, there's just a lot of secular tailwinds for the industry. So I think in the long term, this is not going to be meaningful.
Tony, I guess my question to you is, since Gabelli is a shareholder of Boeing, whether or not, I guess at what point would you then become concerned? And maybe would this alter or influence your view on Boeing?
Again, I think they're going to come to some reasonable, end to this. Obviously, I think the union wants to have their employees employed and working, and this is it's a great company. It's obviously it's an American icon, and I think Boeing will negotiate appropriately. Obviously, there's some things in there that I think are going to be difficult to overcome, like a defined benefit program, which is just, I think that's just not a modern way of having some form of benefit program in a modern economy. So I think there's some things that are going to have to be worked out, but in the long run, I think this will get wrapped up relatively soon, and Boeing and the union will be on their way.
And will Boeing still be a profitability competitive company at the end of it and on the other side, as that was one of the warning signs that they were communicating? Right.
Again, I think the devil's in the details, of course. But if Boeing's producing at rate for the 737, getting back to essentially around 50 jets a month, which it was doing pre mishap, that's almost about 10 billion or so of EBITDA on a run rate. So that turns into a pretty profitable cash flow engine. And of course, there's a $500 billion of backlog in Boeing's commercial book. So I think there's a lot of runway to go for Boeing.
To what extent do some of those costs then get passed on to the airline operators that either have future orders that they'd like to place with Boeing, because this wouldn't impact, I imagine, at least some of the existing contracts that they're delivering on. So now it really kind of goes out to how Boeing is selling itself and its product, and the innovation that is going to be set to come in years down the line versus an Airbus. And kind of on the competitive metrics there, how can they say, all right, X amount of aircraft are going to be delivered, the pricing is going to be just a little bit higher as a result of this deal, and which airlines are perhaps most likely to say, you know what, we'll just take delivery of the aircraft that we have right now, and then we'll see later on down the line how many we can take on from there.
Yeah, that's actually a great point, Brad. That's very insightful, and that's sort of the crux of it. Historically, what has happened is the OEMs have passed along those increased costs to their customer, in which I believe the customer is readily willing to accept, as they need these planes. These planes are not, it is a razor blade model, and the razor blade is the plane, and they only have so many cycles in them, and they need new aircraft. And and Airbus, for all intents and purposes, is in a similar situation. I mean, they have talked about their production numbers not making what they were expecting in their initial outlook. just recently. So they're in a similar situation, and it's the COVID made a lot of changes to the supply chain, and that's what we're I think in the situation right now. But it will it's going to improve over time.
Tony, what do you think the priority needs to be for the new CEO there? Obviously, it's been a tough start when you come into the fact that he has been dealing with these strikes and negotiations that don't seem to be making obviously as much progress as they had hoped. What do you think needs to be that near-term focus aside from getting some sort of deal on these negotiations in order to get Boeing back on track?
Yeah, Sean, I think that you hit on that's the key. Number one, they've got to knock out this negotiation issue and get the strike settled and move on. They were obviously moving right, and they just put out their deliveries yesterday, and actually the numbers were pretty good relative to expectations. So they were on track to recovering after the January 5th incident. That's number one. Number two, they need to work with the FAA, and I think it will probably meld at the same time where they're getting to about that 38 rate, and the FAA will probably take off the 38 cap. And then number three, just getting the supply chain squared away on the 787 and the 737. And then lastly, the defense business, they need to make that business profitable, more profitable, and get those those fixed price development contracts coming off and improve that.
All right, Tony Bancroft, Gabelli Funds Portfolio Manager, Aerospace and Defense ETF. Thanks so much for joining us.
Thanks so much.
All right, we've just seen the opening bell on Wall Street. You had some advertisers at the NASDAQ, and you had an Olympic silver medalist at the New York Stock Exchange. Let's take a look here at the major averages as we begin today's trading activity. Taking a look at the Dow Jones Industrial Average. Out of the gate, you're seeing it down by about 0.2%. The S&P 500 flat just barely to the downside there. We'll see if that can make its way into positive territory. And the NASDAQ composite out of the gate here this morning, you're taking a look at that. Seems like it's hyper oscillating as of right now, flat, just barely to the upside, and now it's negative. So just as quickly as it was happy, it's sad. But we'll continue to take a look at that as we go on throughout the day. Take a look at XLK technology, of course, for that NASDAQ composite, the tech-heavy average there. You're seeing that kind of reflected and playing out within this XLK as well. The S&P 500 look at the technology sector here. That is flat, kind of mirroring what we just saw with the NASDAQ a moment ago. But take a look at this. A move higher for consumer discretionary by 0.1%. A lot of laggards here on the screen. You've got staples trickling into positive territory. We'll see if we maintain those gains as of right now. You've got energy, though, pulling up the caboose. That's down by about 0.9% to start off the day. Let's take a look at some of those tech names here for the NASDAQ 100. You've got a lot more red than green, it seems at least, among some of those largest value cap companies. And taking a look at NVIDIA, as we were just mentioning a moment ago, having a lot of favor with teens right now. It's up by about 0.9%. That, of course, according to the latest Piper Sandler Taking Stock with Teens survey. And we've got much more movement. For that, let's toss things on over to Jared Blickery, who's standing by at what we call the Big Big.
It's great here by the Big Big. Let's pull up the interactive there. I do want to note that we're looking at the NASDAQ here. I'm going to strike this, change this to the S&P 500. We have just been consolidating near highs, and yesterday was no different. Today doesn't seem to be any different. Is it going to be the day that we break out? Well, this bull market now turns 2, and if you're wondering how long the average one, I believe it's 4 or 5 years. So historically, we have a little bit of room to run here. Also want to note, I'm going to show you a 1-month chart. Callie Cox was noting this. We have had an up, down pattern now going back all the way to late September. This has not happened since 2015. All this means is the market's going sideways and consolidating for the next move. I would err on the side of the bulls just because that has been the long-term direction here, but anything can happen. I want to check out the 10-year T-note yield because that is kind of at a crossroads right now. I'm going to draw a line here. Let's see how good it is. Bumping up right against it. It looks like it broke out, but it's actually right there. And then you just have it clearing the 4 0.0% level. And I think if it breaks to the upside, well, we probably get some momentum that could be bad for stocks. If we break to the downside, probably going to be more of a tailwind for equities. And Brad, I was looking at NVIDIA too. I just want to show how close we are to record highs. Let's take a look at year-to-date actually, and you can see right there. The magic number is 135.58. That's on a closing basis. And intraday, we actually hit 140.76. And that's just a little bit higher there. So we could be saying a lot of records pretty soon if we get some upside momentum, or maybe it's just going to be another seesaw day. Also want to check out Apple here because unlike NVIDIA, it's just kind of consolidating a little bit to the downside. But we have this pennant formation. And this is another area where if it breaks out, well, we should get some movement in that direction. Want to close with silver here. Silver had the worst day since July 25th, SI equals F. And a lot of people saying that's kind of a rug pull. I'll show you a line chart here so you can see it, but it's still pretty close to these highs, but it just doesn't look like it's going to break out to new highs today. Anything can happen, as we say, but that is the trend.
Anything can happen. All right, Jared Blickery, thanks so much for breaking down some of the trends that we are seeing here at the open. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. You're watching Morning Brief. Time now for today's strategy session. U.S. stocks trading mixed ahead of tomorrow's CPI print, where investors will get the latest read on inflation and the Fed's path forward. But could the economy be headed for a bumpy landing? Our next guest think that might be the case. Victoria Fernandez of Crossmark Global Investments. Victoria, it's good to see you here. So talk to us about why maybe you aren't sold on that soft landing scenario.
Yeah, I mean, everyone is anticipating we're going to have this soft landing. I think it's priced into the market. It's why we're seeing these high valuations on equities, and we'll see if earnings supports that or not. But really, when you look at the economy, there's so many conflicting elements that you have, whether you're looking at spending and you've got high-income consumers versus low and middle-income consumers. You look at earnings, S&P 500 are doing okay. You look at small caps, they're not, and only about half of them are actually showing a profit at all. You can see it in the employment component, cyclical versus non-cyclical jobs. You look at the last payrolls report, which I don't want to take away from it being a great number, but a lot of those jobs were all from the non-cyclical element. It was from education and healthcare. It's the cyclical jobs where we really want to see some gains, and we're not seeing that either. And you see it in production, manufacturing down, but services up. Again, all these elements, even CapEx with what companies are saying they're going to do. Small business report came out this week. CapEx looks like it's going to decline. So because there's all these conflicting elements, we think we will get a bumpy landing. We will have a slowdown, and it will probably be some volatility in this market. So I think that's going to be a better option or a better outlook as to what's happening versus anticipating a soft landing.
Where do you believe the top buying opportunities are if we were to see continued volatility?
Yeah, so with this volatility, we continue to want to be in the market because it is back to a momentum-driven market. You don't want to stand in the way of that. So be invested, but you've got to be a little bit guarded. We do like those elements of the market that are showing new leadership. So like industrials are showing new leadership. Even financials are still showing relative strength versus the market. So those are some areas. But if you want to have a little defense, I know staples and healthcare have come back some as of the last week and a half. You can start some positions there, but look at adding some dividends into your portfolio for that cash flow. Add a little fixed income. So again, you have consistent cash flow in your portfolio to help buffer the volatile markets we think we're going to see over the coming quarters.
Victoria, when it comes to the plays that investors should be prioritizing right now, right? I think we have seen a little bit of this flight to safety. You can clearly see that in gold. You can see that in some of the other traditional safety plays. Is that a trend that you see continuing here, given some of the uncertainty or some of the unknowns that you're talking about?
Well, Shauna, you said the key word, right? Uncertainty. There is nothing the markets dislike more than uncertainty, and it does give you that flight to quality component. We haven't seen it in bond yields, but I think that's because they're repricing some of the rate cuts that they had assumed were going to happen, got a little bit over their skis there like they did earlier this year, and that's being repriced. But you're continuing to see gold do really well. I know Jared was talking about silver a moment ago, didn't have a strong day, but it's still up towards the top end of its range. And again, I think you can see people maybe moving some money into some of those staples names or some of those more defensive areas of the market. I don't think you want to go all in because you don't want to take yourself out of participating in the higher momentum that the market seems to have right now. But it does make sense to have some allocation to those safer parts of the market, especially with the geopolitical issues we're seeing, and obviously with an election where we're not really sure what the outcome will be of that.
Certainly, all of those events as risk factors, but also could be potential tailwinds because they are forces of uncertainty. And then once we get the certainty on the other side, what type of momentum do you think we'll see off of the back of those once things become more defined?
Yeah, once uncertainty is removed, and I think you get more of that tailwind that you're mentioning into the equity markets. And I think that's where names like financials will do well, especially if we see the yield curve starting to steepen again. We saw that. It came back a little bit over the last week, but financials give you a really good opportunity to take advantage of a steepening yield curve. Industrials, again, we're talking about their relative strength. And if you think that once we get past these uncertainties that you're going to see growth continue in the US and globally, then industrials is a good place to be as well. I also think if momentum and growth is what you believe is going to happen, you can go into some tech names, maybe not necessarily, those Mag 7 names, but look at some other areas within tech. We have holdings, in some names like a Qualcomm or a Taiwan Semiconductor. Look at some of those areas that you could probably add if momentum is going to continue to drive this market higher.
Just lastly, Victoria, while we have you here, it seems like tech is facing even more legal battles now. We were just breaking down Alphabet of course, parent company of Google, and their new fight that is brewing against the Department of Justice here. And then even more so internationally, some U.S. tech companies are being targeted. And when you think about all of that as kind of a swirling wind around these companies, what does that kind of signify for the tech trade, or at least the traditional search engine trade, if you will, annexed to digital advertising?
Well, I think it's why you've seen some of those names pull back as much as they have. Regulation is a key issue here. We've seen it forever, right? We're in the middle of it with Apple as well, opening up their wallet. We're seeing what's going on with Google, and it's not going to end there. We know it's going to continue, and these are very long, drawn-out cases. So you're going to have regulation issues continuing. I think that's where you have to come back to an element of look at these companies for the long term, look at their cash flows, look at their earnings consistency, look at their balance sheets. Which of these companies are going to be able to withstand some of those elements? And like I said, maybe it's different areas of tech that you can venture into. You want to have allocation there and exposure to the tech industry, but I think you have to accept the fact that there will be some ups and downs in that sector as we go through the next few years. And again, we don't know exactly what will happen. Let's see after the election if any policies start to change.
Victoria Fernandez of Crossmark Global Investments. Thanks so much for taking the time, Victoria.
My pleasure.
Coming up, everyone, Hurricane Milton is on track to hit Florida's west coast as early as today, bringing with it the threat of widespread power outages. The CEO of utility company Tampa Electric joins us on the other side to discuss. Hurricane Milton is barreling towards Florida's west coast, expected to make landfall late Wednesday evening or early Thursday morning as a dangerous major hurricane, according to the National Hurricane Center. Post-COVID elevated transformer prices have left utilities with limited resources to repair damage, making power grids like Florida's more susceptible to hurricane impacts. Let's bring in Archie Collins, who's the CEO and president of Tampa Electric, an electric utility company serving more than 800,000 customers in Florida. Archie joins us now from Tampa. Archie, certainly wishing the best for you, your team, your family down there, as everyone is looking to stay safe. Just walk us through the preparations and ultimately what you're monitoring here in advance of the storm.
Well, good morning, and thanks for having me on this morning. Here in Tampa, quite frankly, all across Florida, Hurricanes are something we're very familiar with. We train year round for hurricanes like this. In fact, this is the third hurricane we're dealing with this year. We dealt with Debbie earlier, a couple of months ago, Helene obviously just 2 weeks ago, and now Milton, which clearly seems to really be packing a punch. We train year-round. Our employees are up for this challenge. We operate a very robust, a very modern, a very resilient electric grid. 52% of our distribution grid actually lies underground, which will be helpful at a time like this. For this particular restoration, which is shaping up to be the biggest in our history, we have actually marshaled 5,800 utility workers from all across the United States, from as far away as Texas, Missouri, Illinois, that are currently, we have those resources right now marshaled up in southern Georgia so that they are out of harm's way. And they will travel down here after the storm has passed and begin to support our restoration. This is the largest set of utility workers we have ever assembled for our restoration, and it just gives you a sense of what we are bracing for here in Tampa.
That certainly does give us a sense of what is headed your way. Archie, I've read so many articles here and coverage of this storm and the expectations for the devastating impact that this could really have on Florida's power grid. Could this potentially be unprecedented, perhaps, in some ways?
It is shaping up to be unprecedented for us here in, at Tampa Electric, where we're situated right on Tampa Bay. What's so important for us is exactly where the eye makes landfall, and because where you are relative to the eye really makes a difference. If this system passes to our north and we get the strongest surge, and what you can hear what's being forecasted, 10 to 15 feet. Clearly, that will have a catastrophic effect on some of our coastal communities, who are already dealing with some of the impact from Helene only 2 weeks ago. So, if you contrast that to if the system makes landfall to our south, then some of that surge is muted, and in that case, we're dealing with more of a wind event. So at this moment, we're planning for both a surge, both a major wind event. Clearly, we are hoping that it is only a wind event and that our customers are spared the worst of that powerful storm surge.
Archie, Florida has been experiencing a transformer shortage, and I know it has been due to a number of factors, part of this being some supply chain issues. When you're facing a storm like this, how much worse can that make that situation? And I guess how long will that then, or how much will that delay maybe restoring power here in the future?
The transformer, the supply chain issues surrounding transformers is certainly not a unique. It's not a unique phenomenon for Florida. It's an industry-wide issue. Here in Florida, because we are prone to hurricanes, we keep a very strong inventory of transformers for this very reason, so that if we get hit with a major hurricane, we have what we need in order to effect a timely restoration. So, clearly, the damage that is inflicted by Milton is going to be a function of where this thing makes landfall, but we are confident. Our inventories are strong. They remain strong post-Helene, and we believe we have everything we need to support a timely restoration from Milton.
Archie, we only have about 30 seconds here, but as you think about quantifying the impact of this, is there kind of a round number that you, your team, and officials locally are working with and trying to communicate that in advance to FEMA even?
That's such a difficult question to answer, because clearly until Milton makes landfall, we really don't know. I guess as a point of reference, Helene, which was a very efficient restoration for us in a matter of about 48 hours, that was a $45 million price tag. Milton has the potential to be significantly more than that, but it would be irresponsible of me to give it a price tag before it actually makes landfall.
Certainly.
Archie, thank you so much for your time today. I know it's a very challenging time with the hurricane headed your way. We really appreciate you taking the time to join us. Thanks so much.
Thank you very much.
Coming up, we'll be taking a look at some of today's top trending stocks and breaking down why they are moving. We got your top calls when we come back.
Time now for a look at the analyst calls moving stocks this morning. You can find all of these tickers on the Yahoo Finance website by scanning the QR code below. And we're doing it in less than 30 seconds each. Starting with the home improvement stocks here. We've got Home Depot and Lowe's receiving an upgrade from Loop Capital. The analyst behind the call suggests that recent hurricanes may disrupt sales for the current quarter, but investors will likely look past this as demand for home improvement remains robust. They looked across some of the resolutions to port strikes as well. They did see a prolonged strike as a material risk. However, they noted some of the stores most recently could benefit after some of the extreme weather events and rebuilding thereafter as well here. They also said that stores look great. So a little bit of a foot check.
I always love to hear that if you want to be positive on Home Depot. All right, let's take a look at Southwest. It's also receiving some love this morning after Jefferies upgraded the stock from underperform to hold. Jefferies saying that the airline is taking the right steps into profitability here, but you might notice that it still is a hold rating, and here's why. He's saying that the numbers, though, seem very lofty. Execution is still key, but he wants to give credit where credit is due, putting in his words there. So we are seeing a bit of a gain here today, up nearly 2%. All
right, and TD Cowen, somebody over there clearly has a pet. They're bullish on Chewy. Analysts at the firm's starting coverage on the online retailer of pet products with a buy rating and a $38 price target. Take a look at shares of Chewy here on the day. They're up by about 3%, just a little bit more than that. But over the course of the year to date, you'll remember this name has certainly tried to rally and battle back here. It's up 36% year to date. Still a lot ahead for the company to try and prove to investors that this can be sustained profitability and that pets are going to get that continued dollar allocation within the household.
It's costly. All right, keep it right here on Yahoo Finance. That does it for Morning Brief. But stay with me for the next hour. I've got you on Catalyst. I will be joined by my co-host, Madison Mills. That's coming up right after the break. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. Let's get to the three catalysts we're watching this hour.
First up, the Justice Department weighing a breakup of Google in what would be a historic decision for one of the world's biggest technology companies. We're going to break down the implications for Alphabet and the broader tech sector with a former FTC commissioner.
Plus, we'll stick with tech and hone in on investing in the artificial intelligence space, how one venture capitalist is parsing through the wave of generative AI startups to find the next open AI.
And investors turning their focus to the latest Fed meeting minutes out later today. The minutes could clarify the Fed's decision to cut by 50 basis points from back in September. We're going to break down what we can expect as we look ahead to Thursday's inflation print. But sticking with Google could be headed for a breakup. The Department of Justice weighing a split for the company, citing unhealthy competition in the search engine market. The DOJ is saying in a filing it is, quote, considering behavioral and structural remedies that would prevent Google from using products such as Chrome Play and Android to advantage Google search. Google responded to the recommendations, saying the government seems to be pursuing a sweeping agenda that will impact numerous industries and products with significant unintended consequences for consumers, businesses, and American competitiveness. Joining us now to discuss, we've got Moselle Thompson, former commissioner of the FTC. Moselle, great to speak with you again here. To start it off, I just want to know, what does the market need to know about the potential implications of this?
Well, the first thing they need to know, this is going to take time no matter what. I mean, we're in a second phase, the second part of the trial. The court has already found that Google's a monopolist and did some things that they thought were anti-competitive. Now the second stage is the remedies phase. What kind of remedy will address those kinds of harms that the court found in the first part? Usually those cases take a long time. When I mention a long time, it could be a year, it could be 3 years. Remember Microsoft, it took many, many years. So it's an interesting problem. What the market needs to know is that in the meantime, the market and innovation keeps moving forward.
Moselle, what do you think is the most likely outcome?
Well, it's going to be difficult. Let me tell you something. Breakups are hard to do. That it's an unusual remedy, and it doesn't occur very often. In fact, we've seen it rarely. Remember Microsoft decades ago, and you have in 1984 an agreed breakup for AT&T. People today still have questions about whether they were very effective in addressing the dominance of those companies in the marketplace. So I think what investors need to know is that when this takes time, to recognize that at the same time, you have competition in this area. Google has been dominant in search for a long time, but don't forget, we've had this explosion of artificial intelligence. AI, the deployment of AI means that people have an alternative to Google searches, that they can use artificial intelligence to search the web and get answers that they may used to have had to rely on Google to find.
So are you saying then, Moselle, that the AI boom could kind of be doing the DOJ's job for them?
It is one of the things that people note. You know, one of the challenges for any of these court cases is that you're dealing with facts that have already happened, and as part of antitrust, you're trying to be forward-looking. But it's kind of hard to guess what the forward-looking is at the same time the market's iterating and innovating. So it's possible always that the kind of remedies that you might want to put in a court decision will be outdated by the time it's on a piece of paper.
Moselle, this has certainly put the rest of the tech industry on watch. How should companies, or do you think this is enough to prompt companies to rethink their strategies or rethink their positioning here going forward?
My sense in talking to tech people is that they're already rethinking. They're examining what they do and how they do it. But what's the larger question is, what does the innovation practice in the Valley look like? You know, one of the things that the tech has always innovated, how they've done it, is by acquisition. Well, the recent regulatory actions have put a little bit of a chill in that, so that the antitrust regulators are looking at acquisitions and are concerned about whether they support or achieve market dominance for a company who's doing the acquiring. At the same time, companies who are innovating are looking for those kinds of investments in order to keep going and to create the next big thing. So it's going to be a continuing discussion and dialogue as to what the real way forward is on a policy basis.
Well, Moselle, how much of this has to do with who wins the White House in November? And I guess ultimately, whether it is Harris or whether it is Trump in the White House, what impact then will that have on innovation, the exact topic that you're talking about here?
Well, I think it's going to have some impact, that it's not entirely clear that the Kamala Harris administration is going to take the same kinds of positions or in the same way across the board that the Biden administration has. At the same time, we know that the Trump administration, the potential Trump administration, has its own bones to pick about the tech industry, but it may be picking its own winners and losers because they clearly favor some innovators more than others. So the jury is still out, as they say. But no matter what happens, there's going to be an opportunity to press the reset button in January.
Well, it's interesting because the former Trump administration kind of kicked off the regulatory pressure on companies like Alphabet, and then obviously we have the Biden administration in the White House right now. It makes me wonder how much who's in the White House matters if both sides agree that more regulation is needed for the tech industry.
Well, I think the larger question has always been, yes, there has been some agreement on that, but what form it takes and what how you measure the impacts, that may yield different kinds of results depending on who's sitting in the front office.
All right, Moselle Thompson, former FTC commissioner, thanks so much for joining us here this morning.
Sure, thank you.
Coming up, we're taking a look at some of today's trending stocks on Yahoo Finance. We'll give you the news behind those moves next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Tesla, reporting record quarterly shipments in China, up 19% year over year, with vehicle deliveries from its Shanghai factory up for the third month in a row. EV makers in China are benefiting from a government subsidy encouraging drivers to trade in old cars for electric alternatives. We've seen this across the board with the increase in demand, especially for some of those domestic players. Obviously, Maddie, when you take a look at this and the fact that it's rising 19% compared to the same time last year, that very much is looked at as welcomed and good news here for Tesla. I don't know how much this momentum maybe, I mean, we're actually not seeing any momentum today with the stock up just about 0.1%, but more so a lot of this is riding on what we're going to hear tomorrow from the robo-taxi event and really what that tells us about the future of Tesla. But we know clearly China, a very, very important market here for Tesla, one that they have been struggling with to compete with some of those domestic players now for quite some time. Lots of questions about what the future is going to look like. So again, that type of growth, a 19% growth, massive step, I think, in the right direction here for Tesla.
Absolutely. And we know that Tesla has been leaning into some of those incentives to get consumers in Beijing to purchase those EVs. Having said that, we do know that in the region more broadly, Chinese automotive stocks have been up over 30% over the last quarter here by market cap basis. That's according to Bloomberg Intelligence here. So that's indicative to me that the stimulus money that's being used to get consumers in China to be spending more, that's having an impact more broadly on the auto space. So it's not just good news for Tesla, and that may be why we're not seeing much of a bump on the stock. Also, investors awaiting that key robo-taxi event. Tickets are on sale as of now, so we are certainly going to be monitoring any potential headlines to come of that event, and also any pricing pressure that Tesla might announce about, or pricing details that Tesla may announce about the robo-taxi as well. Let's move on to mining company Rio Tinto, set to acquire Arcadium Lithium in an all-cash deal worth $6.7 billion. Rio will pay $5.85 per Arcadium share. That's a 90% premium on Arcadium's closing price last week. This will make Rio Tinto one of the top producers of lithium, and that is one of the commodities that is used in the largest batteries for EVs. So that's something, just to give you some context, this news is related to kind of the demand picture that we were seeing on EVs, and lithium is a key part of that because it is the primary commodity utilized for large EV batteries. I do want to point out something that we heard from the CEO of Rio Tinto as well. In their last earnings print, he said that lithium could constitute a very meaningful contribution to their earnings moving forward. And they also added that the deal was made now because of the fall in lithium prices that we have been seeing amid the commodity deflation challenges, a fall of more than 80% from their peak here.
Yeah, exactly. And this deal comes after its own efforts to build up from the ground up have stumbled just a bit. So they're looking to make this acquisition and push further into the lithium business through this M&A activity that we are seeing today. What's interesting to me, and you pointed it out there, just the attractiveness, at least from Rio Tinto's view, following the decline that we saw in lithium prices. And a lot of that because of the surplus that we saw in supply, and then also couple that with the weakening or demand that wasn't as strong as had been initially expected for EV. So it could be a challenging couple of quarters, potentially a couple of years, but this is more of a longer term play. And I think that exactly goes back to the commentary that he had on that last earnings call, saying that he is very confident that it is going to be, quote, a very meaningful contribution here to Rio Tinto's earnings, not necessarily one I don't think that's going to come right off the bat. So it's more of a longer term play, but also just, I think, reinforces the importance here of lithium as we talk about this energy transition and the future demand that we could see here for EVs.
Yeah.
All right, finally, China's stock rally fading just a bit. The Shanghai Composite falling more than 6%, and the Hang Seng down more than 1% after yesterday marked its worst day since 2008. Of course, though, coming on the heels of the massive run-up that we saw last week. Yahoo Finance's Alexandra Canal is here with a closer look. Allie.
Yeah, Shauna, so that you mentioned the Hang Seng Index, that's loaded with large Chinese companies, and we did see that drop another 1% today. So continuing those declines that we saw yesterday. You mentioned China's benchmark CSI 300, that dropped 7% along with that Shanghai Composite, as investors really are fully digesting this news. And what it really boils down to is that expectations were for a supersized stimulus package, and what we got on Tuesday was pretty much a nothing burger. Now, remember, back in September, we saw the most aggressive stimulus from China since the pandemic, with the country saying it is committed to reaching its 5% annual growth target. That's part of the reason why we've seen such a run-up in these stocks. And investors, they believe that there's more fiscal policy to come due to that commitment from China. But Wall Street is split at this point about whether or not now is the time to buy into this market. Here's one point of view about why maybe you should sit on the sidelines for now. Take a look.
We think long term, we'd rather be in India, Japan over the long term. The short run pop is, hey, people are feeling better, they're starting to stimulate. Will it be enough to move their economy? Is very much an open question. The sentiment was so negative, but there's also good reason why it's tricky.
That's Jeremy Schwartz, Chief Investment Officer at WisdomTree, and he's very focused on the geopolitics of it all and the risk that comes along with that. But on the bullish side, we've seen Goldman Sachs, HSBC, BlackRock all upgrading mainland China stocks in recent days. A lot of that has to do with valuation still at historic lows, and with hopefully more good news to come on the stimulus side, that should be bullish for China in the long run. But that's the big TBD factor that really has investors on edge right now.
Well, it's interesting, too, because there's this question out there about whether or not the stimulus is just a sugar high, because ultimately consumers have to recover and have to be spending for us to see kind of a long-term recovery. What does that look like to you, Ali, in terms of where China stocks are going and what the next big mover for those stocks could be?
Well, we've really seen those consumer staple names, a lot of the e-commerce giants, Alibaba, JD.com, they've seen such massive surges. We are down over the past 2 days, but still we are up significant double digits there. And yes, the stimulus is going to have a trickle-through effect through the economy. There's mortgage relief, there's debt relief, which I think is something that a lot of the consumers are really looking for. But it seems like we need more support on the fiscal side, not just monetary. Economists, they're expecting a big number of fiscal package worth $284 billion to be announced. That seems to be the magic number there, and that also is what was probably expected from yesterday's announcement, which we just did not get. So the fact that we've seen this policy fatigue since the pandemic, China has said they're going to do more and they just have not. That is a bit of the frustration there. But given that we saw such a significant package in September, that certainly shifted the narrative. So if China can't come out and continue to bring that fiscal policy, bring that big number, we're going to see those depressed levels in the stock market, and we're going to see that pain really echo even more. So, it's something that size and execution, that is the two things that people are really focused on.
Yeah, and it's interesting given that we know so many hedge funds have been very bullish on China, but it looks like it was just a 2-week stint, at least for now.
For now, we'll see.
Of course, we will continue to monitor. Ali, thanks so much for bringing us your reporting on that. Appreciate it. Coming up, we're discussing how investors should be looking at bank earnings kicking off here on Friday. Stick around for that right here next after the break.
The next big test for the market is going to be earnings. We've got big bank earnings kicking off later this week. We're starting on Friday with JP Morgan, Wells Fargo, and BlackRock all reporting before the bell. To discuss how investors should be looking at the reports and maybe how to position ahead of that is McCrae Sykes. He is Gabelli Funds portfolio manager. McCrae, it's great to have you here on set. So talk to us about what we should be expecting from bank earnings, from the financial sector at whole, because when you take a look at those estimates versus zeroing in just on the banks, there's a little bit of discrepancy. So what should investors be prepared for?
Well, I think overall, I think it should be a pretty good earnings season. We do know that there's going to be some headwinds from NII shifting around a little bit, but the S&P Financials is up about 10% for the quarter, so good anticipation of the results. You have the S&P up 6% during the quarter. That's good for wealth and asset management contribution in terms of fee revenue. Deposits up 1%, 4% annualized, so that's supportive of balance sheets. NIM's kind of, in the same. We had this surprise 50 basis point cut versus 25 in the quarter. That's not really going to be impactful, but that gives a good setup for going forward in terms of the net interest margins more normalizing and getting better going into 25, 26. So I think investors are going to be looking through these earnings, looking for better earnings acceleration in the next years. And of course, the consumer's doing pretty well, credit's doing pretty well. So pretty good setup as well.
What can we expect to learn on not just the health of the consumer, but also the economy and the degree to which that larger than anticipated rate cut is impacting banks' balance sheets?
So I think there's a lot of data points that's going to be going in, and you have a firm like JP Morgan, very asset sensitive. There's going to be some pressure on their balance sheet going into next year, and they've talked about that. They lowered guidance a little bit at the last quarter, but you're talking about something generating $91 billion of NII this year, maybe down below 90 next year. So kind of a little bit of a headwind as opposed to Bank of America. With a net interest margin ratio of around 2 versus 3 for JP Morgan, is going to start to see that benefit a trough this year and acceleration next year. So, the tale of a couple of cities there. And that's the case of a lot of the different banks. But in general, I think better NII metrics going into next year.
What do you think the commentary is going to be surrounding the shift that we've seen from the Federal Reserve? So we did get that 50 basis point cut, but I think obviously the debate and the conversation that we've had with so many of our guests here over the last couple of days has been whether or not, or I guess to the degree that they're going to be cutting here before the end of the year. How much will that then, if we only see 25 basis point cuts between now and the end of the year, how much is that then going to delay maybe the recovery that we're expecting to see in banks?
So we try not to focus too much on the monthly metrics in terms of predicting rates.
Right.
Obviously we follow the 10-year and what's going on, and that's our North Star, and that's actually been flying quite a round, going from 360 now up to 4. I would say, though, even though the 50 basis points was a surprise versus 25 probably as expectations, I think the layout in terms of the rate cuts over the next 6 months by the Fed and getting that, whether it's another 50 this year, and what the forward curve suggests, or I think that's well within kind of the expectations for the banks as well. So to the extent that we start to get slow rate cuts, I think the banks will react accordingly, and that will be a good environment. And then we've seen the rate curve in general flatten out, so stop the inversion, and I think that's a good path to recovery in terms of managing your liabilities and assets.
I want to talk a little bit about a couple of the names that you have for us here and some of your top holdings. I know you really like Wells Fargo. Talk to me about why. What's the bull case?
So Wells, as you know, has been an underperformer, over the last 7 years because of this asset cap. They've had a number of, headwinds in terms of regulations. But there was a news article a couple of weeks ago that suggested that maybe finally in the final phase of completing the requirements for the asset cap. And with the stock trading at a little under 1.4 times tangible book value for 25, if we were to get that relief, I think that would be very bullish for the stock. And, we talk about getting probably to a 15% ROE, so it's, over $6 of earnings next year. That's predicted for 26, so that would pull forward. And I think people would also appreciate this stock in terms of the path to growth as well. So I think within the big bank sector that's done very well this year, there's hidden value in Wells Fargo, and given that article that we got recently, I suspect that we could get some feedback on the third quarter call about that and a path to getting free of that, and that would be certainly a good catalyst to the company.
And McCrae, you also have some regional banks within the top holdings here when you take a look at Charles Schwab for Citizens Bank shares. I'm curious, the health and the stability of the regional banks at this point. What's your assessment?
So we've been pretty picky about that sector. First Citizens, as you know, acquired Silicon Valley at almost double book value through the transaction, managing incredible integration with that, and then some benefits. But they'll face some NII headwinds next year because of their costs with their bank lending facility, et cetera. So we really like that stock. The very entrepreneurial management team, great outlook there. Again, I think the regionals in general will be better positioned in a normalized curve, and as we've seen, the CRE to some extent has stabilized a little bit. Real estate's doing a little bit better, so I think that helps them. They're more sensitive, certainly, to NII than, say, the bigger banks, which have more contribution from other segments as well. So, but I still think you have to be careful. We do have the Basel III requirements at the end of the year as well. So we like some of the regional banks, but we've been focusing on the big banks for a number of the.
I want to end with one more question on the big banks, specifically Bank of America. And I know you've got Berkshire and B of A. Is that an inherently contradictory thought now, or am I
Well, we own Berkshire for a number of reasons, and it's one of the largest participants in the S&P Financial, so we're obviously indexed to it. But Bank of America, obviously, when the biggest shareholder and one of the world's foremost investors is selling, clearly it gives you pause. But I think there are a number of reasons that he may be selling, and in addition to the appreciation that the bank has accumulated over the last couple of years. So I think narrowing of the position and also just where it has come and managing the overall balance sheet ahead of perhaps a change of management in terms of risk management for the overall portfolio for Berkshire. But again, you have to do your work, and we still see pretty good trends for Bank of America. Great call by Moynihan, a couple of weeks ago in terms of the outlook. So we see them managing well and producing good results.
All right. Well, we got to leave it there, McCrae, but really appreciate you joining us in person. Thank you so much. McCrae Skies over at Gabelli Funds. Well, the other big test for markets this week coming up here is CPI, that inflation print. For investors who monitor macro conditions, a lot of the focus has shifted from inflation over to the labor market. So how much can we expect the data this week to move markets and yields? Joining us now to discuss, we've got Veronica Willis. She is the global investment strategist over at Wells Fargo. Veronica, it's great to speak with you. So talk to me about the degree to which you anticipate the inflation data that we're expecting out tomorrow to move markets.
Yeah, I think it has that potential to be a pretty big market mover, especially if we see inflation even just a little bit hotter than what we're expecting. I think, you hit it right. The market has shifted very quickly to that focus on the labor market, seeming to have declared that we've got, the Fed has beaten inflation, and I think that might be spoken a little bit too early. The Fed has been very careful to maintain that they've got that dual mandate, and they're still focused on inflation as well as the labor market.
So is that not fully being priced into the market? And I guess when you talk about the fact that the risk of the inflation print coming in slightly hotter, what do you then anticipate the equity market reaction to be?
I think the market has priced in that inflation will continue to cool, but I think that the risk is to the upside with inflation, and that's not really being priced in. So if there are any surprises with tomorrow's report, if there are any surprises the rest of the year with inflation, that could be a catalyst for some market volatility.
You talk also about expecting in the fourth quarter of 2024, both equity and fixed income price chops starting to position for a better 2025. What does that tell us about how you're thinking about positioning specifically in the fixed income space?
Yeah, specifically in fixed income, we wanted to move away from both the short and the long-term sides of the curve and focus in on intermediate. With the Fed having started cutting interest rates, you've got that reinvestment risk in short term. And we also think we've seen that peak in long-term rates. And so really just moving to the middle of the curve there in anticipation of rates continuing to come down next year.
What are your expectations for where the S&P is going to be by year end? And when you talk about that balanced approach here that you seem to have heading into the end of the year and into next year, how does equities fit into that? And I guess more specifically, where are you finding those opportunities?
Yeah, we think we're going to see some more volatility through the end of this year. Our, midpoint target is 5,400 on the S&P 500. So we do see the potential for a pullback. But we're really focused on positioning our clients thinking through 2025. So yes, there's going to be some volatility through the end of the year, but that could present an opportunity to do some rebalancing, get your portfolio positioned in the right way to be ready for that growth that we're expecting in 2025.
And Veronica, I do want to ask you about the tech trade. To what extent do you anticipate tech being the biggest driver of gains for this market moving into the end of this year and early next year?
Well, I think we've already seen the market broadening a little bit. Tech is not that major driver, at least in recent months, that we've seen over the past couple of years. And I think we can see that, continuing to hold. We've been encouraging our clients to, diversify outside of the tech sector. We're not unfavorable there. We want a neutral kind of full allocation to tech, but we do like some of the other sectors that have a little bit more of attractive valuation. So maybe taking some gains that you've gotten in tech and rebalancing a little bit into, communication services, industrials, materials, financials, energy. So those are some of the sectors we like a little bit more right now.
All right, Veronica Willis, really appreciate you joining us. Veronica is over at Wells Fargo Investment Institute as their global investment strategist. Now, coming up, Hurricane Milton, hours away from making landfall in Florida. We'll discuss what the devastating storm means for businesses in the state next, right here on Catalysts.
The National Hurricane Center warning that any last-minute preparations, including evacuation, should be, quote, rushed to completion this morning as Hurricane Milton rapidly heads towards Florida's west coast. Walt Disney World joining a slew of theme parks closing today in anticipation of the, quote, catastrophic storm. For more on how Milton could impact businesses in Florida and beyond, we want to bring in Bill Kirk, joining us here on set, founder and CEO of Weather Trends International. It's a weather forecasting company that helps firms make decisions around weather-related events. And your client list includes Target, Microsoft, JP Morgan, just to name a few. We have a few other names up there on the screen. But Bill, I guess before we get into the impact specifically on these companies, talk to us just about the degree of what the economic damage could look like of a storm of this magnitude. And then since you do predict these types of weather patterns a year out, did you predict this?
Yeah, so actually we put out a video back in January predicting the worst hurricane season since Harvey, 2017. We're having that now, even worse than Harvey. Worst tornadoes in 13 years, worst floods since 1993. So a lot of those things, you can see that in our statistical math-based approach to predicting year-ahead weather. This Milton, I think there was a cartoon back in the day, right? It turns into a monster. This is a monster. Ian, back in 2022, 2 years ago, did 121 billion, and it only hit Fort Myers and swampland. Okay, this is hitting Tampa, Sarasota, Disney, Cape Canaveral. I mean, this is hitting a lot of assets. So we're projecting at least 121 billion. I just read a report today, they said 15 billion. I said that'll pale in comparison to what, So you just look at the Ian was, the other thing is this is moving about 12 hours to go across the state. That's destructive. It's great if it's 2, 3, 4 hours like Ian. This is not the case. This is a 12-hour event.
So talk to me then about, obviously it's an incredibly severe weather event. At what point does the severity tip over into being so severe that it is not a potential for upside profit margins for a Home Depot because the devastation is so vast?
Home Depot will tell you they always love a threat of a storm. Everybody buys their supplies, but it doesn't hit. Unfortunately, this hit. So it does damage to their stores, obviously. I think Home Depot has about 7% of stores in Florida. Not all in the path, but about 7%. Now, Publix, I think, has like 64% of stores in Florida. So there's definitely a downside if your stores are destroyed. Now, they're home centers, right? They get up to speed real quick versus your Macy's, that's going to take a long time to repair. So it's a net benefit. You typically find about 0.5% to 1.5% lift in overall company sales from a hurricane. So there's definitely Home Depot, Lowe's, Tractor Supply, they benefit from these storms usually. Everybody else, not so much.
And talking about the fact that we do see increase of sales just depending on what weather-related events were, in your notes, something stuck out to me. You talked about the power of 1 degree and how temperature change really impacts various industries. To what degree does that impact those industries?
So we have a lot of severe weather clients as well, but it's just the everyday weather. People want to look at this event. This is a one-time event, and it's going to have an impact, but it's small. It's the everyday weather. So look at June. June was the hottest in history. We had the coldest summer in 10 years. A year ago, and then this year's the hottest. Everything went through the roof. You bought everything you needed seasonal sales-wise, from beer to you name it, air conditioners in June. Well, then July was colder, a little cooler and wetter. It was cooler year on year. August was even the coldest in like 5 years. Hot, but still cold. The trend was negative. You look at store traffic, did the same thing, right? A phenomenal June, softer July, softer August. And then what happened in September? We were on a negative trajectory for same-store sales, store traffic, if you will. And then September, we have the coldest in 40 years in the Northeast, and boom, store traffic shoots up. So we're humans, right? So this everyday change of 1 degree times 10, right? We say, beer sales every degree hotter, there's about a 1% increase in beer, 2% for Starbucks, 10% for air conditioners, right? So air conditioners went through the roof, 300-400%. So it's just that small volatility of weather has a huge impact every day.
What are you telling clients then about how they should be preparing for that?
So again, what we do is we project them their sales. So we're projecting sales a year ahead. I know it sounds crazy, but we do a year ahead weather by week, by store, everywhere on Earth. So the good news is we think Q3 is kind of softish. You've had blips of good. August being cooler, wetter was good. September having that brief cold spike was good, but then it got really hot again, so that's not so good here in October. So it's okay. Q4 we think is very strong. We have a very cooler, wetter, snowier, La Nina type winter. So we think it'll be stronger. Last year was the hottest in history, right? So the sales were delayed until the polar vortex hit in January last year. This year, moving all those sales up at full price, full margin product. So we're very bullish on Q4, and then we have a train wreck in 2025. I mean, we have cold, wet spring. We have snow into April. La Ninas are famous for late season snows, colder summer.
This coming spring?
Yeah, so it's we call it the out of sync year. It happened once in 07, 08. Retail recession.
Bad news, Bill.
Yeah, sorry,
I don't like
that's what we're saying. But you prepare
it.
for it, right? Better to prepare than react, right?
That is true. You know what, my question to you is, as there has been more focus on climate change, as there has been more of these extreme type of weather events, are you hearing more then from Fortune 500 companies that are using a service like yours, or maybe using your service and then factoring that into their financial models? Is that something that is becoming more prevalent?
You always find that when the weather's extreme and severe, like 07, 08, right? We had a retail recession, the weather was horrific. We did phenomenal. We were up 91% that year, right? So when, I don't want to wish ill on anybody, but when the weather's more extreme, people do think, hey, I got a plan for this. I'll give you an example, like peanut butter. These things that people buy are just crazy, like mousetraps. People will buy millions and millions of mousetraps in advance of the storm. Women will line the houses of their destroyed kitchen with mousetraps because mice come in with flooding, right? Yeah. So it's uncanny with thousands of seasonal items. So yeah, the weather is definitely volatile, no doubt about it. And again, we're going into La Nina cycles. So everything this year, we had tornadoes, hurricanes, and floods. Next year is going to be the cycles will flip. Next year will be more about drought, fires. Fires are just starting this year. They're going to think they're bad, worse than 7 years this year. Next, worse than 10 years next year. So fires, droughts, and hurricanes would be the theme next year, not convective tornadoes like we had this year.
Have you heard from any of your clients in Fortune 500 companies about thinking through whether or not to move out of these areas and to relocate their businesses because of severe weather events?
Yeah, no, not really. I mean, again, you're always, people are going to live with, the sad thing about Florida is you've had so many people here in the Northeast, right, that now live in Florida that have never experienced a hurricane. They tell you to get out, right? I mean, these are killer storms. So no, I mean, again, you got to be careful because everyone will react, right? They'll react to the floods this year, insurance companies, right? They're all, convective storms are killing insurance companies this year. Next year will be droughts. So all the things they may reinsure, let's reinsure against tornadoes and, and hail events for next year we get droughts and fires. They're always guessing or planning off of last year. So we try to eliminate that big surprise. If you just get that piece right? You're ahead of the game versus reacting.
Yeah. All right. Well, Bill, thank you so much for breaking it down for us. We really do appreciate it. Thank you so much. Bill Kirk joining us in the studio. Well, the search for the next big AI company, how Microsoft's venture capital fund looks for the best investments. We'll cover that and more next on Catalysts. Oppenheimer sounding bearish on Microsoft, the firm downgrading the tech giant to perform from outperform. Oppenheimer saying Microsoft could face losses in the $2 to $3 billion range from its OpenAI investment next year, thanks to slow enterprise adoption. So the key thing to listen out for here, right, is concern about AI moving forward here and the expenditures coming in from AI and AI revenue moving forward. The analyst behind the call saying that overestimated near-term AI revenue is a concern here. And Sean, I think it's interesting when we broaden this out a little bit, looking at some of the other downgrades we've gotten this week, even Wells Fargo downgrading Amazon, for example. Is there a question out there, Jeffries with Apple, is there a question out there about the longevity of the tech trade and whether or not there's been a little bit too much bullishness?
Yeah, and I think we started to see that creep in. Well, it's been a couple of months at this point, but especially on the heels of its most recent earnings print, right? Because there was a lot of concern. You could see it reflected in the day after, a couple of days after we saw their last round of earnings numbers, just the amount that they were spending and their CapEx plans for the remainder of this year and going into next year. And a lot of that was just based off of questions of how long it is going to take for some of these AI bets to essentially pay off and what that boost is going to be to the bottom line. So, and then it's very similar to a conversation that we had with Gil Luria over at D.A. Davidson not too long ago, talking about the current valuations right now and how much of this has already been priced in, and the fact that it is still trading well above its historical average, or 10-year average, I should say, just in terms of 30 times estimated earnings, which is below that peak, but still above the 10-year average, has caused many people to question Microsoft's valuation in particular. But again, when you take a look at the run-up that we have seen in the stock price, we've got a 2-year chart up on your screen right now, up just about 80% year to date. It has been an outperformer there, largely because of their massive bets on AI. But I think the big question is how long that is going to last and maybe what that roadblock could be here, at least in the short term.
Absolutely.
But overall, though, the street still remains positive on these tech names. So
right.
It is important to couch that. Some analysts are starting to take some issue or call out maybe some weakness that we could see. But overall, we are still seeing a bullish activity here across the board for many of these larger cap tech names. Well, sticking with tech, Microsoft's venture capital fund is on the hunt for the next big AI company, following the success of its investment with OpenAI. Joining us now is Michael Stewart. He's M12's managing partner. Michael, it's great to have you. So talk to us. We were just citing a note from Oppenheimer here a moment ago, talking about the investment opportunity, or maybe some of the questions surrounding AI investments here, at least in the short term. I'm curious, just from your perspective, given your experience, what you make of this excitement surrounding AI and how you're shaping your strategy to identify the investments that make the most sense within this sector.
Yeah, thank you, Shauna. We're looking at this from a long-term point of view because we are investing in startups that could take some number of years to grow into their business plans, and I think reveal, the technology's promise, which is the basis of the excitement of so many investors and also entrepreneurs entering the space. So it's not really what we do at the venture fund, I think, to focus on perhaps like the day-to-day market as much as what could be upcoming, what is beneath this inflection, and the value that's being created here, we think, is fundamentally unlike other technology trends that I've seen in my career, developing technology or investing, and it's reflected by the capital coming into the space, but also the entrepreneurs who are leaving sometimes great, high-paying big tech company jobs to found companies with other like-minded individuals.
But isn't that also just potentially a story, Michael, from those entrepreneurs and from the investors coming into the space? How do you suss out kind of the reality from the buzz of just slapping the use of the term AI onto everything?
Yes. Yeah, we are absolutely not looking for a pastiche of AI on top of a company we've all seen before. And, we apply a strategic lens to every new company we look at. First, is the company creating value? Is the company doing something useful for the customer? But there's 4 real factors that we analyze, and they're called the 4 Ds: data, dividends, distribution, and delight. And each one is an aspect of both the technology infrastructure, the data that goes into the model. And in the sense of data is the new oil and other contexts where we may have heard of the importance of data before, data really is the ingredient that makes the application or the service unique here. And paying off, for the customer, if you're an entrepreneur and a team and you're not speaking to those two pieces, the data that you're using to stay different and the results that you give back to the customer, it's really like those two steps are the ones that entrepreneurs should focus on the most. Beyond that, getting to the customer, the distribution piece is where we have an advantage investing on behalf of Microsoft in startups who could reach these enterprise customers that are oftentimes inundated, flooded with so many new signals, so many companies arriving in the space. We want to help use Microsoft as a partner in the future to reach those customers under the guardrail, safety, and reputation that Microsoft brings, as a partner to them. And then the last is really delight, and that's kind of it's a qualitative factor that we think about, but it's just the excitement that someone feels in using a new service. It can touch different kinds of AI startups differently, but it's certainly something that it's your voluntary choice to use an application to work with a company because there is so much choice. We're looking at something like 10,000 new AI startups created over the last 2 years. In that kind of environment, you've got to have customer enthusiasm and love as a key piece of it that's not always technological. It could be something of a matter of taste.
Well, Michael, I guess when you're trying to suss out what opportunities make the most sense, and you listed off, there are thousands of new AI startups right now, right? A very, very crowded field. Is there a next OpenAI? Are we early enough in that cycle? And I guess when you see that growth opportunity, what do you think the focus of that company should be or needs to be in order to have that type of success?
Yeah, and that's where, again, let me delineate between the technology magic that a startup can bring and their ability to create a big business that's of scale and of consequence, again, to collaborate with Microsoft. I think that, looking for a new singular winner in the technology race is a very tough thing for venture capitalists to do, because you'd be really looking for research breakthroughs or other predictions about where the technology is headed in its architecture or the science that could be in some ways less important than focusing on the go-to-market, servicing what customers want. Why would I feel that way? Well, we've seen technology advances come that completely change our mind about the status of the space technologically, but then it's usually just a few months or a year later that there are alternatives to using the technology from other suppliers, other labs, other creators of the technology. And we think, again, from an investing point of view, it's going to be the business creators, their go-to-market skill, and their ability to sell to enterprise that will let us look at these businesses the way we would look at any other business, whether it's a public or private company. The faster an entrepreneur comes to that realization and thinks about the unit economics, communicates it to investors, and realizes it in a business plan, the more likely you'll create one of the lasting companies of the future, one of the new top technology giants of the future.
All right, Michael Stewart, we got to leave it there. Thank you so much for joining us. Michael Stewart is a managing partner over at M12.
My pleasure. Thank you.
Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith will have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're talking about the markets and the best investment moves that you can make as the Fed continues its rate-cutting cycle. The anticipation is there, coming off of that 50 basis point cut at the September meeting. And mortgage applications ticking lower last week as mortgage rates rise. We'll discuss what we're seeing in the housing market ahead of September's key inflation print. Plus, the average FICO score dropping just slightly from a year ago. We'll explain what a FICO score is and why it's under some pressure this year. And don't miss our interview with Childcare CEO Paul Thompson. Yahoo Finance's Brooke DePalma will be live with Thompson at the New York Stock Exchange as the early childhood education provider makes its public debut. Tune in at the midpoint of this hour. But first, let's do a check of the markets 90 minutes into the trading day here. Stocks, they're trading higher right now, looking to build on Tuesday's gains. The moves come ahead of the FOMC meeting minutes due out 2 o'clock p.m. Eastern Time today. They'll give investors some more insights into the Fed's thoughts around rate cuts. Plus, Wall Street is eagerly awaiting September's inflation print, that out Thursday. So here to discuss what this all means for markets and your portfolio, we've got Kevin Phillip, who's the partner at Bel Air Investment Advisors. Kevin, great to have you here with us. So as we're weighing the economic data plus the kickoff of a new trading or earnings season rather, where do you think investors are apt to place more prioritization on the deluge of information that's being digested this week?
Hi, Brad. Thanks for having me. Appreciate it. And it's a great question. And I think it's really important that an investor, if you're in it for the long term, to have that long-term perspective and to not get drowned by the abundant noise that you're referencing, which is an appropriate thing to reference. So I think at the end of the day, I'll quote kind of the Shakespeare, to thine own self be true. Know what your goals are, know what your financial circumstances are, and plan accordingly with your investments. And I think for the vast majority of people, it's keeping things simple. It's having a diversified basket of investments that are high quality, not employing leverage, and averaging in your exposure over time with the intention of holding things for as long as possible and not triggering sales and capital gains taxes, et cetera.
So with that in mind, where are your favorite picks within the market right now as you're kind of charting out what that averaging into a position could look like, and then even more longer term, some of the themes that you're expecting to play out and benefit portfolio positioning?
Sure. I think you have to have a core element to your portfolio, which is going to be kind of index hugging. The S&P 500, for example, maybe a little bit of growth. I do favor growth over value. Value has only outperformed growth 3 or 4 of the last 15 to 20 years, roughly, from what I can gather from when I've been doing this. So I do favor growth. That tends to that includes technology. So I would keep a core of S&P 500 U.S. large cap companies. I'd satellite that with technology companies using either the NASDAQ or the Vanguard large cap growth. You'd have some small cap and mid cap to try and get those sweet spots of accelerating growth from small companies. And you may want to include some non-dollar denominated exposure to a smaller degree with international stocks. And if you're in the individual stock playing game and you have a couple of favorites and you're going to do that regularly and stay on top of the news flow and the statistics of those stocks, you can start, you can satellite that approach with some individual names that you like to follow.
Kevin, as we had teed up at the beginning of the conversation, of course, we've just kicked off a new rate cutting cycle here. How should investors be kind of drawing up the playbook for what this cycle may hold, especially when we're trying to get a better sense of what the neutral rate is and ultimately kind of the terminal for what this cycle could hold for not just a few meetings from the FOMC, but several meetings, depending upon how deep they decide to cut over time?
There is a fuller plate in front of us when it comes to investments and the economic circumstances than I've seen in a long time. And as it relates specifically to interest rates, I think we have to keep in mind a couple of things. Everyone, lots of people, not everyone, are very focused on housing, how to get into the housing market, how to upgrade their house, whatever the case may be, how to lower their rents. And I think to a large degree, the cutting of the interest rates is going to help in that. And I have this conversation often with clients where they're trying to wait for interest rates to come down before they buy a house. And I remind them that sometimes, it's better to act now, tighten the belt, get into the house, and when interest rates come down, you can refinance and bring your costs lower. Because if you wait for that perfect moment, you'll just be in kind of the race to acquire new homes. The other areas specifically related to the stock market, you can look at the banking sector. As interest rates come down, they'll be able to generate more loans, which should be more lucrative. A lot of the big banks carry commercial debt on their balance sheets. As interest rates come down, the mark to market on those prices come up, which will favor the earnings outlook in their balance sheet. M&A activity is likely to pick up in a lower interest rate environment. That's also good revenue for the largest banks, so you can watch that. And then also, when you think of which sectors do well in a lower interest rate environment, the tech sector tends to have multiple expansion. Investors are willing to pay up for higher growth in lower interest rate environments. So you don't necessarily need earnings in those companies to go higher. If interest rates go lower, historically, people pay more for those stocks, so the stock prices go up.
And just lastly, while we have you here, of course, we had mentioned CPI and how that's going to be in focus Thursday here and really going to kind of have some effect in the back half of this week, even as we start to get some earnings prints flowing in for Q3 here. What categories would you be most focused in on CPI to get a sense of where the consumer, the health of the consumer is at right now and what's played out largely at this point for Q3 and how companies might talk about the health of the consumer for Q4 and their outlooks?
Yeah, great question. There are a few components. As it relates to the CPI, I'd focus on a couple of things as potential noise and not necessarily indicative of a fundamental theme. The shelter component of the CPI tends to be lagging. So if it comes in at a higher print, you might want to take that into account. The other area is energy. With the current circumstances in the Middle East and the escalation of oil prices because of that, if the energy component comes in higher than anticipated, not to mention the hurricanes hitting that have hit Florida and North Carolina and another one on track for Florida, if the energy segment of the CPI comes in higher, you want to kind of understand the recent news that is probably affecting that and ask yourself whether it's indicative of a long-term trend. And you had another point to your question that I lost track of in the course of the CPI.
Oh, no, that's okay. It was kind of getting at within the CPI and engaging the health of the consumer, where we might also see that show up in how companies this earnings season are discussing the consumer and that factoring into their forecasts.
Right. So I think the best measure of the consumer's health is keeping an eye on the labor market. If the labor market stays strong, that tends to favor a healthy consumer. There's always going to be noise about subprime borrowers or credit card debt that is becoming delinquent, things that I would keep an eye on. But you're always going to hear that on the edges. I wouldn't anticipate that becoming a bigger theme as long as the labor market holds. So, but I'd look at both labor market and credit card delinquencies, which will be forecasted by banks.
Kevin, thanks so much for taking the time here with us today. Kevin Phillip, who is a partner at Beller Investment Advisors. Appreciate it.
Thank you, Brad.
Certainly. Keeping with the economy, small and mid-sized businesses seem to be doing mostly all right. Nearly 80% of business owners anticipate revenue growth this year, and the majority are planning to expand, according to a Bank of America study. But confidence lags a bit with smaller businesses. To break down how entrepreneurs are feeling about the year ahead, we've got Raul Anaya, who is the Bank of America President of Business Banking. Great to have you here with us. So what is your best sense right now of the confidence of business owners, especially as they're trying to close out the year strong in 2024 and then kind of set some of their expectations for 2025?
Brad, look, overall, the report is a positive one. As you said, nearly 80% of business owners that we surveyed across the country feel really good about what's going on within their business. 80% are expecting revenue growth next year, which bolsters confidence and their focus on expanding their business. Almost 70% are looking to expand their business. more than half of them look to hire to support that growth. So overall, it's a good report. The next 12 months, confidence is a big part of these business owners. That's if they feel confident, they're going to be making the decisions to invest in new real estate, new equipment purchases, obtain financing for that, and hire more employees.
When you think about how this varies across the sizes of the businesses here, where are you seeing kind of between the small to mid-sized enterprises? How are there some areas that may differ in how they're navigating the environment right now?
So this is a survey of 2,000 business owners with annual revenues from 100,000 to about 50 million. And there was a difference. You know, the medium-sized business owners, about 85% anticipated revenue growth next year, in contrast to our small business owners at 70%. So there was somewhat of a difference, but overall still positive. And you know, mid-sized businesses have larger employee bases, greater resources to be able to really execute on their growth strategies versus a smaller business that might have a handful of employees to, you know, more than that. But overall, there's different challenges that they face. But at this point, the larger companies are a little bit more optimistic about the next 12 months.
Yeah, it's a great point. You know, when we think about some of the economic data that we're getting this week, CPI out Thursday, it's going to give us a good idea on how inflation is trending. How are business owners dealing with pressure from inflation?
Well, you just talk about one of the biggest concerns. While there's optimism and our business owner survey reflects that, there are some concerns, and inflation's at the top of the list. In fact, 70% of the business owners that we surveyed cited inflation as their number one concern. And so for them, they're having to really look at their costs. On average, those that were surveyed, 12% price increases in order to offset the inflationary effect. But it's definitely a top concern of business owners at this time.
You know, drilling down further into the survey and into the findings here from Bank of America, you'd also mentioned that nearly 80% of U.S. business owners anticipate revenue growth in the coming year. And then you drill down even further, majority of women and minority business owners surveyed, they plan to expand their businesses over the next 12 months. What does that expansion look like, and where are they kind of looking across either the business that they operate, whether that be a product or service, and expansion into the offering that they're putting into the market, or even expansion into the workforce that they have as well?
So you touched on something that this survey really reflects, and that's the sentiment of 2,000 business owners that are women and minority-owned business owners. When they think about expansion, they're thinking about geographical expansion. They're thinking about expanding their product suite. They may be going into new product areas themselves. So there's different ways for them to be able to really grow and expand their business. But overall, the report is positive. Like you said, on average, almost 80% expect revenue growth, and that just signifies their strength and confidence in the next 12 months.
Just lastly, while we have you here, very quick, when you think about that expansion, how much of it is leaning on technology? We often think about how there are so many of these business owners that are trying to figure out where they can leverage technology that's going to give them better productivity and dare I say generative AI, but I'll throw it into the chat. Why not? How many of them are looking across these opportunities to bring in more technology, increase productivity, and then that being levered to scale?
Well, we've always surveyed our business owners for many, many years, and we always ask about how they're deploying technology. And technology continues to be a big part of how they interact with their clients, how they increase productivity, how they reduce costs. So that continues to be an important part of their business strategy, employing an online presence. This year, we did ask them about, you know, what do they think about artificial intelligence and how are they using AI within their own businesses? Almost the majority of the businesses are using some form of AI to help with their recruiting, with sourcing potential candidates, and really looking at resumes and making the whole hiring and recruiting process much more efficient. So AI is definitely something that is being deployed by our business owners across the country.
Raul Anaya, who is the Bank of America President of Business Banking. Raul, thanks so much for taking the time here with us today.
Thank you, Brad.
Certainly. Coming up, everyone, we're taking a pulse check on America's middle class. Plus, start planning your ideal retirement now. We'll give you the top 5 best places in the U.S. to retire. That's next on Wealth. Inflation is marked down as middle income Americans' biggest financial obstacle, with 81% calling it a major concern. That's according to a new survey from Santander. Joining me now with more on the findings, we've got the CEO of Santander US, Tim Wennes. Tim, good to speak with you once again here, and welcome back on the program. First, we got to know, of the findings that you are able to kind of extrapolate from middle income America, what's most notably jumped out to you?
Well, the item you just mentioned, 81% saying that inflation is their major concern. That's the highest level we've seen since the third quarter of last year. And so even though we've seen inflation moderate, I think the cumulative effect on consumers is impactful. And 90% have said that they've made some kind of spending adjustment here recently in order to maintain their finances and their financial prosperity in the face of the inflation. Number one is retail spending cuts. But people are also dipping into savings, and they're having to borrow more.
And so with that in mind, how are you continuing to ensure that they have access to, you know, the necessary kind of financial planning here? Because with some of these actions, I mean, it's kind of a give and take, right? You take one thing from, you know, how much you might be spending on a vacation so that you can put it back into other essential items. You know, how are you seeing families really navigate through some of those decisions?
Well, and that's what we've seen. We've seen people have to dip into their savings. That being said, what we also see is people aren't taking advantage of what are still relatively higher rates. We've got people who, with their savings, 6 and 10 have not moved into a higher rate savings account or certificate of deposit. And more than 50% surveyed are earning less than 3% on their savings. And you can find options that are higher than that. And we've got some of those options available here at Santander. And then also 24% aren't even aware of what they're earning on their savings account. So there are some things that people can do with the money that they've already saved to help ameliorate some of the inflation items here.
It seems as well from the data that you were able to publish here, most middle income households, they've remained current on their bills, though more making spending cuts to manage higher prices here. And so what do you kind of read through in that alone, in the effort to make sure that people are still remaining current on their bills, but those bills certainly have, especially for some of the essential areas, whether that be energy, whether that be shelter costs, those have certainly added to or been the primary driver of inflation thus far.
Yeah, so roughly 80% are saying that they're current on their bills today, and that's pretty stable from prior quarters. But we had a 7% increase in those who said that they had to dip into savings in order to stay current on those bills this quarter. And that is why I think you're seeing people saying that they're cutting also back on spending and that inflation remains a high concern and the cumulative impacts have been high. You know, in other parts of the survey that we've done, we've got people who said 53% said that they've delayed putting off purchasing a new car because of new car prices and financing expenses. So we are seeing people make adjustments in order to get by in this higher inflationary environment.
You know, as I'm also taking a look at the survey, you did a breakdown by generations as well here, Gen Z and millennials shifting their mindset around home ownership. You know, as you're kind of looking at how this is going to play out for years potentially, because this does have larger ramifications, what have you seen in the thought process for these two generational cohorts?
The combination of high home prices and higher interest rates and impact on mortgage prices is putting home ownership out of reach for many middle-income Americans, particularly those that are Gen Z and millennials. And we're seeing them also then look at and reevaluate what is a definition of financial prosperity, and that maybe home ownership doesn't need to be part of that financial prosperity for them, and appreciating some of the flexibility and affordability that renting provides to them. And what we are seeing also is half of the Gen Z and millennials that have purchased a home in the past couple of years are saying that they're now living paycheck to paycheck because of the home ownership costs. And nearly half say that they would consider renting again because of the flexibility. I think it's a fundamental shift generationally in terms of how this younger generation is viewing home ownership.
And then just lastly here while we have you, I mean, the number of people that still feel like they're on the way to financial prosperity, did you get a clear sense of how their financial planning, even amid some of the cost pressures, is paying off and how they're kind of planning that out for the long run?
It's interesting. What we've seen through this is, and this is a great chart, that through the last 2 years, pretty stable and consistent in terms of the people who feel like they're on the right path to financial prosperity. They're making the adjustments they need in the near term to help their success in the longer term. So 71%, it's up year over year. It's the lowest point of this year, but still I'd say pretty stable in terms of people who are viewing that they're on the right track to their financial prosperity.
Tim Wenis, who is the CEO of Santander US. Thanks so much for taking the time with us.
Brad, thank you very much. Have a great day.
You too. Mortgage rates ticked higher last week after several weeks in decline. How are potential home buyers reacting to this, and what does it mean for rates through the year end? Joining me now is our very own Danny Romero. Hey, Danny.
Brad, let's set up the scene. Mortgage rates did turn higher last week, which means that potential home buyers and even homeowners were a bit more hesitant. Mortgage Bankers Association reported that demand to refinance an existing home loan fell 9% for the week. And for potential home buyers, applications to purchase even a home was flat for the week. So looking ahead, John Burns' research says that the magic mortgage rate rate is 5.5%, which would help unlock more housing activity. That's what they say. They say that's the magic number.
And so tomorrow we're getting the September inflation report, CPI at least, and housing has been an extremely sticking component, shelter as it's rounded out. What are the expectations?
Like you said, shelter is one of those the stickiest, I would say, component of the shelter equation. Remember, shelter came in August at half of a percent on a monthly basis, and on an annual basis, shelter costs rose 5.2% in August. Now, economists at Wells Fargo expect shelter to reach 0.3% in September on a monthly basis, and on an annual basis, shelter could land at 5.1%. And this is because economists expect those cooler rent prices to really finally feed into the measure. But we'll see, because that's been going on for 2 years now, that they've been expecting cooler rents to be feeding into the official measure of shelter, and that hasn't happened yet.
And so, sticking with housing affordability, Fortune released its list of the 25 best places to retire affordably. I noticed a few counties and municipalities and cities on this list that I recognized and know people who are either in retirement or close to retirement that are in. So what were some of the findings here?
Retirees are looking for a place where they can retire comfortably, obviously affordable, and offer a range of activities. And according to Fortune, California has 2 cities. American Canyon, that's located on the southern Napa County and offers affordable housing and is near some of the world-class wineries. A runner-up is Newport, Rhode Island, known for its scenic beaches, and enjoy some of those Rhode Island tax benefits that the state offers to retirees. I was actually looking into that tax benefit that Rhode Island offers. They allow a subtraction of up to $20,000 for a retirement income on your state return. That makes a big difference when you're filing your taxes. So I thought that was really interesting that Rhode Island is very much more retirement friendly.
Yeah, and of course the honorable mention there, not honorable mention, it made the list. It was top 5 there. Beaufort, South Carolina, of course near Hilton Head Island. So no doubt, I've driven through there a couple times, and nice little retirement population.
Is that an option for you?
It's a hot spot, I'll say that. Why not? Danny Romero, thanks so much, appreciate it. Coming up, everyone, we're heading to the floor of the New York Stock Exchange for an interview with the Childcare CEO, Paul Thompson. Stick around, we've got more wealth after this. Childcare costs remain one of the stickiest pockets of inflation. In August, daycare costs rose 6.2% year over year, outpacing the overall consumer price index, which rose 2.5%. KinderCare is one of the largest providers of childcare in the U.S., with more than 2,000 locations nationwide. And today, it's going public. The company pricing its stock at $24 a share in its initial public offering, on the lower end of its expected range. Shares of KinderCare are expected to begin trading under the ticker symbol KLC today. Yahoo Finance's own Brooke DePalma joins us now with more from the floor of the New York Stock Exchange. Brooke, take it away.
Good morning, Brad. That's right. I'm joined by Paul Thompson, KinderCare's CEO. Paul, let's kick things off with the share price. Your price stand right now at $24. It is a bit on the lower end of your range of 23 to 27. What's your message for investors this morning?
We're really pleased with where we're at. We are very focused on the long term, and the exciting part is the growth that we're going to continue to have as an organization. So very much looking forward to where we go from here and getting into more communities and serving more clients.
And according to regulatory filings, KinderCare does intend to use some of the capital raised to pay off debt. Yes. Can you walk us through how exactly that will look in the near term?
Yes. For this, most of it is going down to paying down debt. So that was an interest of ours to get our leverage where we wanted it to be in a public market.
I do want to hit on the cost of childcare. It's top of mind for everyone. How do you balance increasing profits while also making childcare affordable for Americans?
It's important that it's about education within the center, about having the right teachers in the classroom. Health and safety is so important to parents. So really emphasizing quality and experience and engagement, emotional connection within the classroom is how we think about what we owe the parents and how we show up very well for them.
I do want to hit on ARPA, American Rescue Plan Act.
Yes.
It is rolling off.
Yes.
How will that impact your business?
So the stimulus is ending here in October 2024. For us, it is about moving forward and moving into more communities. Because we have the scale and resources of our organization, we can offer great education opportunities for our own team and great opportunities for us across our different teams.
And so it'll have little to no impact, and you'll sort of adjust as time rolls on.
Right.
I do want to hit on the U.S. election. Of course, it is top of mind. One candidate, Vice President Kamala Harris, is touting a capping childcare costs at 7% for working families. How would that impact your business, and how are you thinking ahead of the U.S. election?
So the great thing about our industry is it's bipartisan supported. If you want a thriving economy, you need to have parents being able to go back to work. Parents need to know their child's in a safe and nurturing environment. So for us to make that happen for them is a great outcome for where we go from here.
Right now, you have roughly 2,000 locations. You are the largest early childhood education provider. Yes. How will you use the raised capital today to expand, and at what rate do you see that expansion going? And how do you increase capacity?
Exactly. We are 1,500 centers. We have 900 sites in before and after school program. So a lot of opportunity for us to continue to go into more clients and give them the benefit of childcare for their employees, and for us to go and serve more families. We're beyond the 40 states we're in today in the District of Columbia.
Last question here. Backup care really increased during COVID. Parents having to drop off their kids last minute. How are you adjusting the business to meet that need, and what sort of need is it?
We are the most flexible option for parents and for employers because we have on-sites at corporate offices, but we also have the 1,500 community centers. So that flexibility sets us apart and why we'll continue to grow as an organization.
Paul Thompson, KinderCare's CEO. Thank you so much for joining us.
Thank you for having me.
Back to you, Brad.
All right, thanks so much. Paul Thompson, KinderCare CEO, and Brooke DePalma for that interview. It's almost that time of the year. 2025 annual Medicare enrollment begins October 15th. If you're looking to switch your plan or not, listen up. There's some changes coming in the new year that could impact you. Here to break down what's new, we've got Yahoo Finance's Carrie Hannon. Hey, Carrie.
Hey, Brad. This is a significant year for changes to Medicare plans, both traditional Medicare and Medicare Advantage. So it impacts about, over 65 million people are participate and are beneficiaries of these plans. And so this year, we have three big changes to focus on that I think it's critical that people pay attention. You started in September, you got a notice from your plan provider saying, what the changes were coming in 2025. So these are changes that are going to start in January. But most people, 7 out of 10 people, just say, skip it. I'm happy. I'm leaving it. I don't want to rock the boat. But this year, don't do that, because 3 new things are coming on. First of all, there's going to be a cap on how much you pay out of pocket for your Part D drug plans. So this is part of traditional Medicare, but that $2,000 cap is really a big deal. And what that means is that Medicare providers, the Part D drug providers, are shifting the plans a little bit. So you want to look carefully if your medications are listed. Have they moved to a different tier so they're more expensive? It's important to really closely look at whether your plan covers the drugs that you're on this year, because this is a business. People are shifting things around. But again, the second thing is a good thing as well, is people, you have to sign up for this, but if you have these Part D drug plans, you can have a plan. Instead of paying for all your pharmaceutical drugs right up front at the pharmacy counter, you can be billed monthly for this. This is super helpful for people with their budgeting, their cash flow, but you do have to go and sign up for these things. Medicare Advantage plans will also see some changes this year, because as more people have shifted into these Medicare Advantage plans, it's now the dominant form of Medicare coverage. Is these plans has gotten kind of expensive because people came to them because you've got vision is included, dental is included, gym memberships, all kinds of fun stuff. But it's a business here. So as more people go in, it's more expensive to operate these plans. So look carefully. Is your Medicare Advantage planning? Your gym membership may no longer be there. Your vision benefit may shift a bit. And again, a lot of Medicare Advantage plans are stepping out of markets this year going into 2025, and health systems are dropping Medicare Advantage plans. So make sure that that you still have access to your doctor through your plans. Now, how are we going to find all this stuff? I mean, it is super complicated. I'm not trying to make it sound simple, Brad, but there are places you can go to get some help, because this year you may very likely see bump ups in premiums. As I said, your drugs may shift around, what's covered, what's not covered. 3 places that I recommend people go to. Number 1, go to Medicare.gov. They have a plan finder. You can compare plans in your area by your zip code, what changes might be afoot and how you can find some help there. The state health insurance assistance program, I absolutely love. They're super helpful. And the website is shiphelp.org. Check that out if you need help there. And also there's the Medicare Rights Center, and it's an 800 number. You can reach out. There are people there to help you navigate that. You can save yourself a lot of money if you just take the time to do some shopping. This year, it's more imperative than ever.
All right, great breakdown and excellent analysis of all of the plans and all the changes. Carrie Hannon, thanks so much.
Thanks, Brad.
Coming up, everyone, we'll tell you how you can find the best high-yield savings rate. Plus, we're breaking down all you need to know about FICO scores. It's right after the break. Stick with us. The Federal Reserve's meeting minutes are out this afternoon, and we'll get a better idea of how the central bank is thinking about its rate cut pathway. One way consumers are directly impacted by changing rates is in their savings accounts. So we want to give you the tips to finding the highest yield savings account that you can get as rates start to come down. Joining me now, we've got Gary Zimmerman, who is the founder and CEO of Max My Interest, a cash management company that helps maximize yield and FDIC insurance coverage. Gary, great to have you here with us. Can you just start by explaining to us the elevator pitch of what Max My Interest does and how it is working with savers?
Well, first of all, thank you for having me back on the show, Brad. Max is an intelligent cash management solution that helps individual investors and their financial advisors earn more on their cash in the bank. For the past 10 years, we've been focused on one thing, which is helping people earn the highest yield while remaining fully insured. And what's interesting is that today, even though the Fed has recently cut rates, the top rate on our platform is still 5.15%, which is significantly more than most banks.
And so now, why are high yield savings accounts so important?
Well, I think they've always been important, actually. The interesting thing about cash is that if you look across affluent U.S. households, they hold about 25% of their liquid assets in cash. That's a lot more than most financial advisors think. And so if you think about a quarter of your portfolio, it should always be earning as much as possible. And what really became interesting to me after a long career in finance is that the market for bank deposits is just shy of $18 trillion in size. Yet it's grossly inefficient. Some people are earning nothing on their cash. Other people are earning more than 5% on exactly the same product, which is an FDIC insured savings account. And when you think about the power of compounding, it's really important to make sure that you're always earning as much as possible, and then it will grow and compound over time.
What tips would you give for someone who's looking for a high yield savings account?
Well, you really need to shop around. And the hard part about that is that the best rates aren't always advertised. So many of the banks on our platform offer preferred rates that aren't available to the general public. And so what our clients do is they come to maxmyinterest.com or they reach out to their financial advisor who can help them get started. And then many of the banks on our platform are posting preferred rates. And the reason they're able to do that is that we take a lot of cost out of the system for banks. So most banks, if they want to reach new customers, have to either build expensive branches or pay a lot of money for advertising on comparison, rate shopping websites. We strip out all of that cost. We actually don't accept any payment from banks per deposit or per click. We think that would create a conflict of interest. And so by taking out that cost, these banks are able to afford to pay higher rates to the clients.
Interesting. So we know a lot of financial planners, they recommend CD accounts, but you've actually got a different suggestion. Can you break that down for us?
Well, look, every client is different, and some people like CDs. But if you actually do the math on it, generally, if a client had a strong view that rates were about to fall and they wanted to lock in a higher rate, they might actually be better off buying bonds because the value of a bond will go up when interest rates fall, whereas a CD really won't change. What we've found, though, over our 10-year history is that in almost all market environments, clients have actually been better off just holding simple high-yield savings accounts. And that way they have full liquidity. And because of the dynamics of the Max platform, where we help clients reallocate their cash to whichever bank is willing to pay the highest rate each month, they're always earning the best rates. And typically the rates on our platform are better than CDs.
Gary Zimmerman, who is the founder and CEO of Max My Interest. Gary, thanks so much for joining us once again here on Yahoo Finance. Appreciate it.
Thank you, Brad.
Certainly. It's been nearly a month since the Fed kicked off its rate-cutting cycle. The implications, they stretch beyond investors and financial markets, and they impact the everyday lives of tax filers. While lowest and lower interest rates can lead to reduced borrowing costs and increased consumer spending, they may also come with challenges that affect tax liabilities and financial strategies. Let's bring in Eric Bodner, who is the BNY Pennsylvania chairman and Midwest regional president, to weigh in. Eric, good to have you on here with us. We received that 50 basis point cut back in September. How are you advising tax filers to prepare for future cuts as we approach filing season once again?
Great. Thanks, Brett. It's great to be on. At BNY Mellon, we make money work for the world. And our framework around that is we manage it, we move it, and we keep it safe. And that framework is perfect for this conversation around managing it. We are firm believers in tax managed strategies. If you haven't already been investing in these strategies, all year, now is the right time to talk to your advisor and think about harvesting any losses that you might have. On the move it side, one of the biggest opportunities here is around what you're doing in the charitable space. Talking to figuring out how you're going to do that, getting that activity away. We like to say, think about giving away the gain and thinking about using low basis positions. And then finally, setting up a donor advised fund is helpful. And then finally, on the keeping it safe piece, review your wills, review your estate plans, make sure they are aligned with where they're going. We often say, well, we're not in the prediction business of understanding exactly what's going to happen in the markets or with tax legislation, but we're in the planning and preparedness business. And to us, that's the key point in any market, to manage it, to move it, and keep it safe.
And so within that planning, how are you anticipating that rate cuts would impact anyone's tax filing plans, especially as the Fed is anticipated to continue, maybe not doing 50 basis points at every meeting, but certainly the neutral rates and the thinking around that from the FOMC seems to have shifted significantly.
That's correct. So both the market and the Fed are kind of forecasting, another 2 cuts this year and maybe 100 basis points next year. So you have to look at, all of your tax liabilities and your estate planning activities, plus your investment portfolio, and figure out which ones are tied to interest rates and which ones have impact. What we've been seeing is, frankly, the opportunities for multi-generational, lending, from one generation to the next, is a key part of this, as well as establishing things tied to interest rates and just looking at the overall asset allocation that you have that might be generating, additional taxable gains. So less taxable interest income equals less taxes overall, is what we're trying to emphasize with our clients.
Certainly. As we kind of drill down into some of the current events taking place, the IRS has announced tax relief for some individuals and businesses affected by Hurricane Helene, giving taxpayers until May 1st of next year to file most tax returns. So what exactly does this mean for the upcoming filing season, and how do people know if they qualify?
Yeah, well, I'd say first off, in any season, again, back to we're not in the prediction markets, we're in preparedness. Start your planning early. There's a number of changes which are occurring, in the next calendar year with the sunsetting of the Tax Cut and Jobs Act, at the end of 2025, which is important to begin thinking about that right now. You need to line up your tax advisors. They're going to be incredibly busy next year. So overall, we kind of prepare for the worst situation that begins, not waiting until year end, not waiting until the beginning part of next year to get affairs in order, and to be prepared to do that, such that if there are delays and are extensions that are granted, that everyone is aware of them and is prepared to move ahead appropriately.
Within that preparedness, households, they like to have a checklist that they can reference and go to. Is there a kind of general rule of thumb taxpayer checklist that BNY, as you work with your clients, that you guys abide by?
Yeah, 100%. We have a firm tax plan. We start early in the year and walk through this around understanding any investment allocations I talked about earlier, any interest income, organizing kind of the taxable and itemized deductions, recognizing that there might be a change going forward next year. So kind of bringing forth any of those itemized deductions into this year might be a good idea. Around charitable giving, around financing, and finally, kind of the golden rule around this is kind of just being prepared and understanding what might happen, but following a systematic approach to doing that and working with your advisors, starting early at the beginning of the year, not viewing tax preparation as something that you handle at the end of the year and the beginning of the following.
Eric Bonner, who is the BNY Pennsylvania Chairman and Midwest Regional President. Great to have you here on the program with us. Thanks so much, Eric.
Thank you.
Coming up, everyone, it's time to open up those wallets and pocketbooks and shell out some cash here. Tickets to Disney World. Yeah, the House of Mouse. They are about to get more expensive. We got the story after the break. average U.S. FICO score holding steady at 717. That's just a point lower compared to last year. But let's back it up here. What is a FICO score? It's created by the Fair Isaac Corporation, and it's a 3-digit number based on the information in your credit reports. And it helps lenders understand your credit risk, aka how likely you are to pay back a loan. The score is weighted using 5 different components here. It's calculated using payment history, accounts owed, credit history, new credit, and credit mix, and that's from FICO. Now, all of this contributes to the score. The scores range from 300 to as high as 850, and the higher the number, yeah, you guessed it, the better the score. And the better the score, the more likely you are to get financing at a good interest rate on, say, a car or a mortgage. Even some landlords require your credit score before they can determine your deposit or even accept you as a tenant. But if your score is, let's just say, less than exceptional, there are ways you can bring it up. Like paying bills on time, using less than 30% of available credit, and having a variety of credit types. And FICO isn't the only credit scoring model. There are a couple others, but FICO is the most widely used. You can find out your score through the company's website or even check your banking app. Many of them give out free FICO scores monthly. Goldman Sachs says Disney earnings may take a hit from Hurricane Milton. Here with me now, we've got Yahoo Finance's Alexandra Canal. Ali, what are analysts expecting here?
Hi, Brad. Yeah, you're right. Hurricane Milton expected to make landfall in Central Florida as soon as today, and it's likely to register a hit to Disney's earnings for the current quarter. Goldman Sachs out with a new note saying that the impact of the park closures and disruptions will hurt earnings at Disney's parks and experience business, projecting a loss between $150 million to $200 million. Now, Goldman compared this to the impact of Hurricane Irma back in 2017, which hit earnings by about $100 million after the parks closed for 2 days, and we also saw some disruptions at certain cruise ships. Disney did close its Florida resorts on Wednesday. Today, it's likely those closures will continue tomorrow as we continue to see this hurricane impact. But certainly the longer this goes on, the more damage that could potentially cause to the parks.
Yeah, absolutely. And this is not the only thing that Disney is doing right now. Disney also raising prices for its highest demand days at Disneyland. What's behind this decision?
Yeah, so this is California's Disneyland. Florida's Disney World was not impacted by these changes, but ticket prices, excluding its lowest priced option, they increased by an average of 6%. So peak season single day tickets, think around the holidays in December, that now will cost you $206 a pop. That's up from the prior $194. If you want to do an add-on like the popular Park Hopper Pass, which allows you to visit multiple parks in the same day, that's going to cost an additional $65 to $75 depending on the season. The company did not raise the price of its lowest tier single day option, which remains at $104. That has been the same price for the last 6 years. Now, in addition to those single day price hikes, we also saw annual passes hit with more sizable increases. It's various Magic Key passes seeing increases between $100 to $125 depending on the specific pass. And this comes as there's been some criticism at this company when it comes to how expensive it is to visit these theme parks. That is concerning to some analysts because we've seen demand weaken as that's occurred. So it's something that the company is aware of. They are trying to offer more discounts, especially on those off-season, off-peak days. We'll see, though, if that's enough to bring people back.
Yeah, great reporting. Alexandra Canal, appreciate the breakdown here. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. They will count you down to and through the closing bell. You don't want to miss it.